Premiums are based on amount of coverage, often determined as the dollar cost of the trip, or range of services requested. For example, a policy with trip cancellation insurance will cost more than a policy without. Length of the trip. However, the premium is generally not proportionally higher because of the general processing fees of all policies. For example, a 50-day policy will not be 5 times the price of a 10-day policy. Risks covered. The higher the risk, the higher premium. Destination. Other provinces in Canada pose the least risk. A low premium is paid due to similar medical costs across the provinces. U.S. and other countries outside of Canada pose a higher risk. A higher premium is paid due to higher medical costs. Other countries outside of Canada considered high-risk zones, that is, some countries in the Middle East and Latin America, a much higher premium is paid. Countries outside of Canada considered too high risk, the insurer will not issue coverage. Age of traveler. Individuals over 65 years pay higher premiums because they are more liable to injury or illness. Medical history of the traveler. Taxation of individual extended health insurance premiums and benefits. Individual extended health coverage premiums paid are not tax deductible. The premiums may be eligible for the medical expense tax credit. Benefits are received tax-free. 4.3. Group extended health coverage. Group extended health insurance covers a wide range of medical services that the provincial health care plans do not cover fully or at all. A group health plan is controlled by its sponsor, usually an employer. The details of the plan are in the master contract issued to the sponsor. Coverage ends if the plan member departs from the group. A unique advantage of the group plan is that there is no underwriting for group members or their family members under the plan, consequently pre-existing conditions are covered. Premiums can be shared between the plan member and employer. Deductibles and coinsurance clauses typically apply to benefits. Types of coverage. Like individual plans, group plans provide coverage for prescription drugs, enhanced medical and hospital care, dental care, vision care, accidental death and dismemberment. Prescription drugs. A prescription drug plan is an important part of an extended group policy since so many people use prescription drugs in their lives on a periodic or daily basis to treat illness. Medication is either sold as prescription drugs, can only be obtained with a prescription. Non-prescription drugs, over-the-counter drugs, can be obtained at any store that sells over-the-counter drugs. Only prescription drugs are covered by group plans. Prescription drugs are often available in both. Brand name. A brand name drug is manufactured by the pharmaceutical corporation that researched and developed it. A patent protects the company's investment. Other manufacturers will be free to make and sell their own version of the same drug, the generic version, once the brand name drug patent runs out. Generic form. The generic drug has the same properties as the brand name drug but is typically much cheaper. An insured who insists on the brand name version will usually need to pay the difference between the price of the generic and the brand name options. A group plan will list the list of drugs it will cover, called a formulary. The price it will pay for the covered drugs. Enhanced medical and hospital care. As discussed, provincial health plans do not fully cover all the health care expenses an individual may incur. Group enhanced medical benefit, also referred to as the enhanced healthcare benefit, plans supplement services not fully covered or not covered at all by provincial healthcare plans. These may include practitioners such as chiropractors, massage therapists, naturopaths, and optometrists. Medical expenses to a maximum annual limit, such as ambulance cost. Medical devices, such as crutches, and upgrades to a semi-private or a private hospital stays to a maximum daily limit and a maximum duration. There may be a coinsurance contribution required by the plan member for enhanced care costs, but there is usually no deductible. Example: As a resident of Ontario, Jonah is entitled to a ward bed in a hospital, paid for entirely by the provincial health plan, if he is ill or injured and requires hospital treatment. His group plan will pay the difference if Jonah wishes to upgrade to a semi-private room. If Jonah wants a private room, he will have to pay the difference in cost between semi-private and private accommodation himself. Dental care. The cost of providing dental insurance to groups is more expensive than other forms of insurance because services are provided continually, that is, twice a year checkups. Dental care does not require a physical referral, it is entirely discretionary. Provincial health care does not cover dental expenses. Emergency medical dental care may be an exception. The insurer and individual must therefore cover the entire dental expense. Dental care is high cost in general. Family is often included in group dental plans. The plan's sponsor, that is, employer, is typically responsible for the premiums for the coverage. Group dental plans reduce their costs through deductibles and coinsurance. Annual maximum coverage. Lifetime maximum coverage. Pre-approval of some costs, for example, pre-approval of semi-annual teeth cleaning, periodic checkups, x-rays and a maximum limit to orthodontic work. Excluding cosmetic work, such as whitening. Vision care. Vision care coverage is an important part of most group health plans. Group vision care reimburses expenses for visual impairment regarding prescription glasses and contact lenses. Optometrist fees, when not covered by the provincial health plan. Coverage is typically limited to between $100 and $350 every 2 years for glasses prescribed by an optometrist. Glasses will only be covered if they are prescribed by an optometrist. New glasses will only be issued in a stated time frame if the insured need glasses for the first time or their prescription changes. Optometrist fees are also sometimes covered by the insurer every 2 years to a maximum dollar amount, in provinces where these fees are not covered by provincial health plans. Accidental death and dismemberment, AD&D. AD&D is a common part of most extended group and individual health plans. Like AD&D described elsewhere, coverage provides a benefit to the insured if dismemberment occurs, that is, the loss of hearing, a limb etc., and a benefit to the beneficiary if the insured dies as the result of an accident. Death of the insured, the benefit is paid as a fixed amount, referred to as the principal sum, and is payable to the beneficiary. Dismembering accident of the insured, the benefit is paid as a percentage of the insured amount calculated in regard to the severity of the dismemberment. For example, the loss of use of an arm pays a benefit equal to 75% of the insured amount. In order for a claim to be paid, death must occur within 365 days of an accident, and dismemberment must be a direct result of the accident. Table 4.1 demonstrates the benefit payable due to accidental death or a dismembering accident. Table 4.1. Sample accidental death and dismemberment schedule of loss. Loss of life. 100%. Loss or a loss of use of both arms or both legs. 100%. Loss or a loss of use of one arm or one leg. 75%. Complete loss of sight in both eyes. 100%. Complete loss of sight in one eye. 67%. Complete loss of hearing in both ears. 75%. Complete loss of hearing in one ear. 33%. Benefits. The group plan benefit is paid as a reimbursement of costs or by direct billing. Benefits may not cover the entirety of all medical expenses. Some medical expenses are not included in the plan, no benefit is payable for such expenses. Many medical expenses are subject to an annual maximum as well as co-payments. Benefits are payable to a certain defined amount. For example, the benefit plan may cover 12 visits to the chiropractor a year at a maximum of $100 per visit or a maximum benefit of $1,000 regardless of the number of visits. Deductibles and coinsurance. Copayment is an integral part of most group plans in order to keep costs down. There are two types of copayment plans by plan members: annual deductibles, coinsurance factors. The insurer will reimburse additional covered medical expenses only once the plan member pays the annual deductible. Example 1. Clarissa is a member of a group plan that has an annual $100 deductible on dental benefits. Clarissa filed her first claim for the current year last month, an $80 bill for dental x-rays. She paid the bill herself and then submitted the bill to her group plan administrator. For the record, the group plan did not reimburse Clarissa anything, but her deductible for dental benefits for the current year was reduced to $20, $100 minus $80. Example 2. Thomas is a member of the same group plan as Clarissa. His first dental claim of the year was $800 for a complicated extraction, requiring a general anesthetic. Thomas submitted his claim but was not reimbursed for the first $100 of the claim, due to the deductible. The balance of $700, $800 minus $100, qualified for reimbursement under the group plan. There are generally two types of annual deductibles when group extended health insurance covers both the plan members along with their families. An individual deductible. A family deductible. The individual deductible is most often lower than the family deductible. If a family member has filed claims that used up all of the individual deductible, no further deductible will be applicable to that person for the rest of the year. Individual deductible claims from any family member will diminish the family deductible dollar for dollar. Regardless of whether the individual uses their deductible or not, individual deductibles will no longer be applicable to any family members for the rest of the year once the family deductible has been depleted. Example 3. John and Marcia are a married couple with one child, Colton. John is a member of a group extended health insurance plan that covers his whole family. For dental claims, the plan has a $100 individual deductible and a family deductible of $250. In February of the current year, John filed a dental claim for $80. He received no reimbursement, but his individual deductible was reduced from $100 to $20 and the family deductible was reduced from $250 to $170. In March, Marcia filed a dental claim for $120. Her individual deductible was reduced to $0 and the remaining family deductible was reduced from $170 to $70. Consequently, $20 of the claim qualified for reimbursement. In May, John filed another dental claim for $100. His remaining individual deductible was reduced from $20 to $0 and the remaining family deductible was reduced from $70 to $50. Consequently, $80 of the claim qualified for reimbursement. In July, a claim was filed for $70 of dental expenses for Colton. His individual deductible was reduced from $100 to $30 and the remaining family deductible was reduced from $50 to $0. None of the claim was reimbursed. In September, an additional claim for $130 of dental expenses was filed for Colton. The entire $130 qualified for reimbursement, despite the fact that Colton still had $30 of his individual deductible remaining, because the family deductible had already been reduced to $0. The deductible is applicable annually, it restarts anew each year on the group contract's anniversary date. The coinsurance factor is also applicable to some benefit claims. The coinsurance factor applies against every claim once the deductible has been paid. Coinsurance factors are most commonly applicable to dental benefits. Which benefits are applicable varies between plans. Both the deductible and coinsurance factor may be applicable when either only a few claims are filed by a plan member or claims are only filed early on in the year. Example 4. Kashif is a member of an employer's group insurance plan that has a $100 annual deductible and an 80% coinsurance factor for dental claims. Last week Kashif went to the dentist and had 2 extractions and some other work done, costing $800. Kashif paid the $800 bill himself and submitted a claim for $800 to the group plan administrator, his first claim of the current year. The first $100 was not reimbursed because of the plan's $100 deductible, but the deductible was reduced to $0 for future claims for the current year. Of the remaining $700 of the claim, the group plan reimbursed Kashif $560, 80% under the coinsurance factor, $700 times 80%. In total, the plan paid $560 of the $800 claim and Kashif paid $240, $800 minus $560. Reimbursement. Reimbursement refers to when a plan member pays upfront for costs, files a claim with accompanying receipts with the plan administrator and is then reimbursed by the plan insurer based on receipts, deductible, and coinsurance. Direct billing. Direct billing refers to when the plan member is provided a membership card or the plan is registered directly with their dentist, pharmacist, etc., and the covered expenses are billed directly to the group plan insurer by the provider. For example, when a pharmacist fills a prescription and directly bills the expense to the group plan because the insured's plan is registered with the pharmacy. The plan member only pays for optional expenses or expenses over set limits of coverage. For example, the insured paying for the difference of price between the generic and brand name prescription. Taxation of group extended health insurance premiums and benefits. Employer-sponsored group extended health plans typically pay 100% of the premium on behalf of the employee. Coverage for family members may have to be paid by the employee. Premiums paid by an employer are usually a deductible expense for the employer. They are not a taxable benefit to the plan member. Premiums paid by an employee are not tax deductible, but may receive the medical expense tax credit. Benefits are tax-free for the employee and their family. Quebec is an exception where premiums paid by an employer are a deductible expense to the employer. Taxable benefit to the covered plan member for the calendar year in which they are paid. Group plan benefits in Quebec are tax-free to the plan member and their family. Integrating an individual policy with a group policy. An individual policy can fill in the gaps of an employer-provided healthcare plan. Insureds may choose to purchase an individual insurance plan to supplement their group health plan due to coverage limits, coinsurance limits, or when the coverage does not meet their needs. For instance, if the group vision plan provides up to $350 in coverage, the individual plan could provide an extra $500 in coverage to bring coverage more in line with actual costs. Example. Arn is married and the father of 2 preteen girls. He is a resident of British Columbia and his whole family has basic health coverage through the Universal Provincial Government Plan. Additionally, Arn participates in the group benefits plan where he works, which offers, among others, group extended health benefits. Arn is concerned that the group plan may not meet all of his family's needs, for the following reasons. It offers no accidental death and dismemberment coverage. It only allows for vision care benefits to a maximum of $100 every 2 years. It limits orthodontic dental care to a maximum of $2,500 lifetime, per insured person. To resolve his concerns, Arn took out an individual extended health policy, with family coverage, structured to provide the following benefits. AD&D coverage. Vision care benefits of up to $250 per family member, every year. Orthodontic dental care coverage to a limit of $2,500 per year with no coinsurance factor. 4.4. Comparing individual and group policies. Table 4.2 illustrates and compares some of the characteristics of individual and group extended health coverage. For characteristics of individual and group extended health insurance policies, see Table 4.2. Chapter 5, Insurance to Protect Businesses. 5.1. Forms of business ownership. The type of business structure an individual, or group of individuals, chooses for business has an effect on multiple issues such as the simplicity and administrative costs of operating the business, the tax rate on business profits, and the amount of liabilities, including creditors, the business owner is exposed to. The following types of business structures as well as their advantages and disadvantages are examined in this chapter: sole proprietorships, partnerships, and corporations. Sole proprietorship. A sole proprietorship is the least formal structure for business ownership where there is one owner of an unincorporated business. Sole proprietorships include many different types of businesses such as consultants, artists, independent tradesmen, etc., and in Canada, the majority of businesses are sole proprietorships. In some provinces, a modest fee is required to register a sole proprietorship. Sole proprietorship advantages: inexpensive to set up, and easy to set up and operate. Sole proprietorship disadvantages: the financial affairs of a sole proprietorship and the personal financial affairs of the sole proprietor are indivisible, that is, no legal differentiation between owner and business. The net income of the proprietorship is the income of the proprietor, and is reported on the sole proprietor's personal tax return. Therefore, the business cannot be taxed at a lower rate, and the sole proprietor's assets are exposed to the business creditors of the proprietorship. Partnerships. A partnership is composed of two or more individuals carrying on a business together with the primary goal of earning a profit. Each partner has a partnership interest. Partnership advantages: partnership costs shared among partners. Partners share revenues and expenses according to partnership agreements. Net income is reported pro rata, in proportion, to the individual partners as stated in the partnership agreement, and income tax is not calculated at the partnership level. The net income is reported to the partners and taxed at each partner's personal marginal tax rate. Partnership disadvantages: the financial affairs of a partnership and the personal financial affairs of the partnership owners are indivisible, that is, no legal differentiation between owners and business. Partners may be held jointly liable for debts and liabilities of the partnership. This means the actions of one partner can affect all partners even if they were not involved in creating the liability. Corporations. A corporation is a separate legal entity from its owners who are shareholders. Corporations are divided into two main categories, private and public. The corporation itself carries on business through the efforts of its owner or operators and employees. Shares are created by a corporation. The individuals who receive or purchase those shares are the shareholders of the corporation. Shares correspond to pro rata interest in the net value of the corporation. Control of the corporation is effected through shared voting rights. Corporations may be small, closely held businesses or large, multinational operations. Corporations are taxed on their net income, often distributing their after-tax income to shareholders in the form of dividends, which are taxed in the hands of the business owner at substantially lower rates than salary or interest. Like policy dividends, stock dividends are not guaranteed, and shares have value in an adjusted cost base that can lead to a capital gain or loss when they are sold. Shareholders are not responsible for corporate debt or liabilities. Privately held. Shares of a private corporation are not publicly traded. Shares are issued to employees and others interested in the business who are generally the owners or operators of the business. In Canada, the net income of a private operating company is taxed at a low tax rate. Therefore, a privately held corporation is often established for tax benefit purposes and deferring tax on the company's profits. Example: Willie operates a business that has net income of $200,000 a year, only $150,000 of which is needed to maintain Willie's personal standard of living. He is in a 45% marginal tax bracket. If he operates a sole proprietorship, the extra $50,000 is subject to $22,500 of income tax, $50,000 times 45%, leaving Willie with $27,500, $50,000 to $22,500, to invest. On the other hand, if Willie's business was incorporated, The $50,000 of undistributed income would likely be taxed at about 15% in the corporation, leaving about $42,500, after tax, $50,000 times 1 minus 15%, to be invested within the corporation. The extra $15,000, $42,500 minus $27,500, accumulated after tax annually would be subject to tax in Willie's hands if it was ever withdrawn from the corporation, but affords Willie much more investment capital in the meantime. Publicly held. Shares of a public corporation are traded freely on a public stock exchange, such as the TSX. Publicly held corporations frequently have tens or hundreds of thousands of shareholders. Shareholders of public corporations are, for the most part, investors who seek to earn capital gains and dividends through share ownership. 5.2. Risks to the business owner. Disability creates risks specific to the business owner and the business itself. There are 3 specific risks related to disability which affect the operation of businesses. These are: risk of being unable to work due to disability, risk of being unable to sell the business, a need triggered by disability, loss of a key employee to disability, inability to work. The owner of a business has to have the ability to generate an income and meet his creditors' obligations. This is contingent on the owner's ability to work and earn revenue. A business owner who is unable to work due to disability risks loss of income with its corresponding impact on financial security and savings plans. The inability to meet obligations to creditors, such as business suppliers. Inability to sell the business. A business is typically the most significant personal asset of its owner. The owner must be able to sell the business when they choose at a fair price and within a reasonable period of time. In the event of disability, disability of the owner may force the owner to sell his business in order to provide an income during a period of disability. The business owner will need to find a buyer prepared to pay the right price for his business in a timely fashion upon the onset of disability. Note that disability is often sudden and leaves little time for planning in advance. Finding a potential buyer, negotiating a price and quickly selling the business are all crucial since business revenues may decline and the value of the business will decrease if a disability drags on for a period of time. The owner may have difficulty negotiating a fair price for the business from a position of weakness, that is, the owner's need to sell. Selling the business or an owner's share of the business creates instability. Employees will be uncertain of their future. Co-owners may be reluctant to take on a new owner and their methods and expectations, and owners worry about receiving a fair price for their business. Loss of a key employee. A key employee is an employee whose activities are key to the success of the business. This may be as a result of producing sales and revenue, product development, marketing or other essential skills. Loss of a key employee can have devastating effects on the business. In the event of prolonged disability, a key employee could be absent from work due to disability. The impact magnifies over time. The longer the employee is away, the more noticeable the effects of their absence. Example: Matty's sole proprietorship printing business relies heavily on the efforts of his sales manager, Ratu, to develop new business and keep current clients satisfied. If Matty were to lose Ratu to a disability lasting more than a month or so, the net business income of $200,000 a year would be substantially reduced, particularly since Ratu is paid a base salary plus commission. Ratu is an ideal candidate for key person disability insurance coverage. 5.3. Insurance to address owner's inability to work. Disability income replacement insurance can be used to replace the income of a sole proprietor operating a business with no employees. If a disabled business owner operating a small business with employees becomes disabled and is no longer able to work, the response to maintaining the business during a period of disability is much more complex. Disability Business Overhead Expense, BOE, Insurance. Business Overhead Insurance, BOE, insurance pays business operating expenses in the absence of the disabled owner. For example, Rent charged for business premises is an expense paid by BOE. Purpose of the coverage. The disabled owner must cover their own personal income needs with an individual disability income policy. BOE insurance excludes a benefit for the owner. BOE ensures business assets do not have to be sold off and their proceeds used to pay the bills. Therefore, it ensures the disabled business owner will have a business to return following his period of disability. Example. Tamru is a professional photographer, operating out of a rented studio, using a leased van for business and employing one part-time assistant. His business earns, on average, $15,000 a month. After allowing for fixed expenses of $4,000 a month, on average, and variable expenses of $2,000 a month, Tamru's gross take-home income is $9,000 a month. He has taken out personal disability income replacement insurance that would pay him $5,400 a month, 60% of $9,000, that ensures Tamru has funds to live on during a period of disability but provides no cash flow to maintain the ongoing expenses of the business. If Tamru were disabled for any length of time, he might have to lay off his assistant and give up his studio and van. Who needs or qualifies for business overhead expense, BOE, insurance? A small business owner who is a sole proprietor or a shareholder of a company with 5 employees or less qualifies for BOE insurance. BOE insurance is based on the idea that the business owner's services are so critical to the profitability and success of the business that an interruption of revenues due to disability could severely hurt the business. However, insurance coverage may be reduced or denied if a co-owner or employee can fulfill the responsibilities of the owner. Definition of disability. The own occupation definition of disability applies. See Chapter 2 for a full explanation of the definition. Own occupation insurance is used by a person who is insured to work only at their regular occupation. If they become disabled and unable to work at their regular occupation, they can receive disability insurance benefits even if they are able to work at an alternate occupation. What expenses qualify for reimbursement? The business expenses that qualify for reimbursement by the policy include, but are not limited to: rent, utilities, property taxes, business income taxes, leases on vehicles and equipment, the interest portion of loans, employees' salaries, phones, internet and other communication charges, fees of professionals, such as the company accountant. Exceptions to payment include the disabled owner's salary, a replacement of the owner, or relatives of the disabled engaged in the business post-disability. New capital expenditures, that is funds spent to acquire or upgrade physical assets such as property, industrial buildings or equipment, undertake new projects, or investments by the firm. The principal portion of loans. Benefits. The benefit is typically paid monthly as a reimbursement of expenses to the business owner or business itself. It is paid until the owner returns to work, the policy maximum is reached and claims, or the business is sold or ends. Waiting period. The benefit period is short and typically begins 15 to 90 days after total disability of the owner due to the fact that the business may quickly fall behind in its financial obligations. Benefit maximums. The maximum is set by the policy. It defines the number of months coverage will be provided multiplied by a dollar amount per month. However, the benefit is only paid to reimburse expenses. For example, if the monthly benefit is $5,000. If actual expenses is equal to $3,900, the benefit paid equals $3,900. If actual expenses is equal to $5,400, the benefit paid equals $5,000. Example. Todd's BOE policy provides for benefits of $6,000 a month for 24 months, but only $4,200 of expenses are claimed for the first month that benefits are payable. The benefit for that month was only $4,200. The benefit period, 24 months, does not really indicate that benefits are only payable for a maximum of 24 months. The maximum monthly benefit multiplied by the benefit period determines the maximum benefit payable under the contract, $144,000 in this case, $6,000 times 24 months. If the full $144,000 of expenses was not claimed within the 24-month period, the policy benefit period would be open-ended, possibly continuing until such time as the entire $144,000 had been claimed. Carryover of benefits or expenses. Business expenses are variable in nature. Some months have higher costs than others. Some contracts acknowledge this by permitting expenses greater than the monthly benefit to be carried forward and claimed in a future month if benefit room is available. For example, the monthly benefit is $5,000 but expenses are $6,000. The $1,000 can be carried forward to a future month when expenses may be less. Benefit room that is not used in a month when claims are less than the benefit maximum to be carried forward. For example, the monthly benefit is $5,000 but expenses are $4,000. The $1,000 that was not needed can be carried forward to a future month when expenses may exceed $5,000. Benefit room that has not been used over the period of the contract to be carried to the end of the benefit period. For example, if expenses were less by $10,000 over the benefit period and the monthly benefits of the policy was $5,000, 2 more months of coverage could be provided if the business owner is still disabled. Example 1. Marie's BOE contract allows for a monthly benefit maximum of $6,000. In the first month of benefit eligibility, the business has qualifying expenses of $6,900. $6,000 of that amount will be reimbursed for the current month and the unclaimed $900 would be carried forward to the next month. If during the next month, a total of $6,600 of qualifying expenses were incurred, another $6,000 would be reimbursed and the $1,500 of unclaimed expenses, $900 from month 1 and $600 from month 2, would be carried forward to month 3. And so on. On the other hand, if there were only $3,000 of qualifying expenses incurred in month 3, $4,500 in benefits would be paid out for the month, the $3,000 incurred in month 3 plus the $1,500 in unclaimed expenses carried forward from the previous months. Example 2. If instead of $6,900 of expenses being incurred in month 1 there has been only $4,800 in qualifying expenses, the full $4,800 would have been reimbursed and $1,200 in potential benefits would have been carried forward to month 2. If $6,600 in qualifying expenses were incurred in month 2, the full $6,600 would have been reimbursed and the remaining $600, $1,200 plus $6,000 minus $6,600, would be available for carry forward to month 3. And so on. Other policies may carry forward unused benefit amounts, but only to be used at the end of the normal benefit period, for example, 24 months. In the event that the entire benefit maximum had not been claimed at that time and the business owner was still disabled. Provisions or exclusions. A BOE policy may include a variety of standard or optional provisions, including waiver of premium, return of premium, future purchase option, clauses for presumptive disability, clauses for partial disability, residual disability benefit. Standard exclusions apply, such as when disability arises from war, a self-inflicted injury, normal pregnancy, injuries or illness contracted in the course of carrying out criminal activities. Tax treatment of premiums and benefits. BOE policies are by and large owned, paid for and payable to the business owner or, in the case of partnerships or incorporated companies, to the business itself. Premiums are tax-deductible expense for the payer. Benefits are taxable income. Benefits paid under business life and disability policies are an exception and are paid tax-free to the business. Nevertheless, the expenses covered by a BOE policy are typically themselves tax-deductible as business overhead, therefore, The tax on the benefit and the deductions of expenses offset each other for tax purposes. Example: Lucian's BOE policy provides for benefits of $6,000 a month, but only $4,200 of expenses are claimed for the first month that benefits are payable. That claim accounted for reimbursement to Lucian's business of $1,800 of business premises rent, $2,000 of employee salary, and $400 of shipping costs for goods distributed. The $4,200 received by the business was treated as taxable income. On the other hand, the $4,200 of expenses paid is a tax-deductible expense. The net effect of the benefits paid and expenses paid is that the business had no tax to pay on the $4,200. Business Loan Protection Disability Insurance. Businesses and business owners can purchase a separate disability insurance to make business loan payments during a period of disability. Business Loan Protection Disability Insurance establishes the business or business owner as the policyholder. The policyholder pays the premiums and receives the policy benefit. The life insured is the business owner. The own occupation definition of disability applies. Purpose. The purpose of a business loan protection disability insurance policy is to pay business loans during the period the business owner is disabled. Business loan protection disability contracts are standalone contracts which offer loan protection as a periodic or lump sum payment in order to cover the business owner's business loan payment obligations. The policy is best taken out when the loan is acquired. Who needs the coverage? This type of policy is best for sole proprietors, partners, and sole owners of incorporated private businesses. When the revenue of the business is dependent on the good health of the business owner. Eligible loans. To qualify for coverage, the loan must meet the following criteria. Essential to business operations. Interest paid on the loan must be tax deductible. Issued by a financial institution, bank, trust company, credit union, or loan company. Who qualifies for such coverage? The business must have at least a 3-year record of profitability. Meet a minimum net worth standard. Satisfy the occupational classification set by the insurer. For example, the policy might only be offered to professional firms. Loans that will be covered must be related to business operations such as mortgages on business property, equipment loans, lines of credit, and account overdrafts. Benefits. Benefit payments are payable as periodic, that is, monthly, or lump sum. Benefits may be paid for loan repayment after an initial waiting period. Periodic benefit payments are typically available up to 24 months, a standard payment is up to $10,000. A lump sum benefit payment of up to $250,000 but limited to no more than 75% of loan value may be also possible. A lengthy waiting period may apply, usually 1 year. Benefit payments are in place to pay the loan balance. Therefore, the benefits paid did not typically exceed the loan's amount. Optional benefits. Other optional benefits may be available such as a waiver of premium benefit, the most common optional benefit. Exclusions. Standard exclusions due to disability arising from war, normal pregnancy, criminal activity, or self-inflicted wounds, etc. apply. Tax treatment of premiums and benefits. Premiums are not tax deductible. Benefits are tax-free. Example. Heidke is an independent contractor, operating a proprietorship with 2 employees. Heidke's business involves digging trenches for the installation of water lines and drainage systems for building contractors and on private property for homeowners. In order to operate his business, Heidke needed to acquire a front-end loader and a small flatbed truck to transport it from site to site, at a total cost of $200,000. Heidke took out a 5-year loan from the bank to finance the purchases. Although the work is not overly dangerous, there is always the risk of injury or illness that could interrupt Heidke's ability to work and earn an income. That, in turn, would impact his ability to make the monthly loan payments to the bank, raising the possibility that the bank could seize his equipment to protect its interests. With this in mind, Heidke applied for a business loan disability policy, with a 60-day waiting period and 60 months of maximum benefits, to protect his investment and the viability of his business. 5.4. Insurance to address the owner's inability to sell the business. Every business owner must eventually dispose of his business in terms of selling the business, passing the business down to the next generation, letting it die or retire with the business owner. It is in the owner and his family's best interest to pre-plan this eventuality, particularly if the business's value exceeds the owner's involvement. Buy-sell agreements. A buy-sell agreement spells out what will happen to the business if the owner or partner dies or is disabled. The document is prepared by a lawyer. The insurance agent suggests how to structure the disability buyout insurance to enable the purchase of the business interest of the disabled. See also the Life Insurance Module, Chapter 8, Section 8.4, which describes the use of buy-sell agreements in the context of the death of an owner or partner. Purpose of an agreement. The purpose of the buy-sell agreement is to provide a succession plan for the business, that is, how to fairly accommodate disability of an owner or partner by ensuring they receive fair value for their interest in the business. The buyout mandated by the agreement will not usually take effect until the business owner has been disabled for a lengthy period of time, usually 12 months or longer, to ensure that the disabled owner is not able to participate in the business. The seller, the current owner, or the owner's estate, heirs or assignees, are bound by the agreement to sell the business interest upon occurrence of the specified event, which is a disability in this case, and the buyers in the agreement are legally bound to buy the interest. Parties to the agreement. The agreement will be written in such a way that whoever becomes disabled becomes the seller. The buyer will depend on the type of business structure. For a sole proprietorship, it is most difficult to find a buyer for the business. The most logical buyers are employees. Partners with a partnership interest will look to their partners to buy their interest. Incorporated private companies will look first to other shareholders to buy the interest of the disabled owner or shareholder. Elements of an agreement. The agreement addresses the many variables that will comprise a fair buyout for all parties to the buy-sell agreement. These elements include: what has to happen for the buying and selling to occur? This is the requirement for the disabled to satisfy the own occupation definition of disability. Will the current owner be required to sell the business interest? Who is required to buy the business interest? When the sale will occur? This establishes the waiting period before the benefit is paid. What the price will be. How the buyers will pay. Typically, the business buy or sell agreement provisions indicate that the agreement is effective in the event of the disability, critical illness, death or retirement of a current owner. Disability is defined under the own occupation definition. The buyout mandated under the agreement will not usually take effect until the business owner has been disabled for at least 12 months or longer, ensuring that the disabled owner will not recover and return back to the business. The current owner and the owner's estate, heirs or assignees are bound under the agreement to sell the business interest upon the occurrence of a specified event, giving the buyer the certainty that they will be able to buy the business. However, the agreement also compels the buyer to buy the business interest, according to the terms of the agreement, once the covered event has occurred, giving the seller the certainty that the business is sold at a fair price. Under a disability buy or sell, the purchase and sale must take place within 1 year, at the very latest, of a current business owner becoming disabled. It is important to establish the price of a business interest in advance. A buy or sell agreement should commit the buyer and the seller to a price that cannot be negotiated when the buy or sell is triggered. The price is established in advance and the agreement has a fixed price. The set price is determined under the agreement. The least preferable method may need adjustment over time as company fortunes rise or fall. A price formula. The parties agree on a formula to value business interest, for example a multiple of earnings. This formula is indicated in the buy or sell agreement. A third-party valuator. A third party assigns a value at the time of selling that will be binding on all parties. A guarantee of the selling price is essential to the buyer and seller. Therefore, parties to the agreement take on the risk of an unknown price when they use the third-party valuator means of assessment. How will the buyer pay? From personal assets. A loan they take on. Payments taken from the business after the buyer has taken over. Insurance on the life of the disabled owner. The buyer is the policyholder and beneficiary. Types of agreement. There are two basic types of buy or sell agreement. An agreement may be structured as a crisscross agreement in which each share owner or partner buys disability buyout insurance on all of the other share owners or partners. Each policyholder pays the policy premium and would receive policy proceeds when disability occurs. For example, the Best Company has 3 shareholders, Al, Bob, and Carl. Al owns a policy naming Bob as insured and another policy naming Carl as insured. Bob owns a policy naming Al as insured and another naming Carl as insured. Carl owns a policy on each of Al and Bob. An entity purchase or share redemption plan in which the business buys disability buyout insurance on its shareholders. The business pays the premiums and receives the insurance proceeds. For example, the Best Company has 3 shareholders, Al, Bob, and Carl. The Best Company has a policy on each of Al, Bob, and Carl. If any of them become disabled according to the terms of the buy-sell agreement, the company receives the insurance proceeds. Taxation issues. A cross-purchase sale creates a capital gain or loss for the seller on their shares in the year the sale is completed. A share redemption plan is taxed differently for partners than shareholders. A partner who sells his or her interest to the partnership will report a capital gain or loss in the year the sale is completed. A shareholder is taxed on the amount greater than the paid-up capital value of the shares. The sum is treated as a deemed dividend and taxed as such. Example. Lawrence, Daryl and Darren were 3 cousins, all in their early 40s, who formed a partnership to operate a dental practice. The practice was very successful, with the cousins sharing office space and net profits from the practice, but each owning their own dental equipment. They had often talked about where they hoped the practice would go in the future and how they would look after each other's families if something happened to one of them, but never took any specific action. Darren was severely injured in an automobile accident, never to be able to return to work or manage his own affairs. His wife, Emily, became responsible for managing his assets, including his dental equipment and his share of the partnership. Lawrence and Daryl wished to acquire Darren's equipment, to be used by a young dentist they hoped to bring into the practice and to buy at Darren's partnership interest. Unfortunately, the 2 dentists and Emily were unable to come to an agreement on price, because the 2 remaining partners lacked the necessary cash on hand to buy Darren's interest outright. An installment purchase was finally worked out, which Lawrence and Daryl will be paying off for some years to come yet. Even so, Emily would not relinquish ownership in Darren's dental equipment, hoping that her eldest son would be able to use it in his own dental office in a few short years. The remaining partners were forced to go to market to replace the equipment at a cost that was twice what they had hoped to pay for Darren's. Disability buyout insurance. The disability buyout insurance accompanies the buy-sell agreement and provides the funding for the purchase of the business interest of the disabled. The 2 should be initiated at the same time so that the features of both, waiting period, benefit amount, definition of total disability, structure of the payout, etc., can be properly coordinated. Definition of disability. The policy insures the owner against disability using an own-occupation definition. The own-occupation definition may be an enhanced definition that restricts work at any other occupation. Waiting period. The waiting period will be between 12 and 24 months before proceeds are paid. For example, Roger becomes seriously ill and cannot perform the regular duties of his occupation. After 12 months, the buy-sell agreement compels his partner to pay for Roger's interest in the company. The waiting period in a policy is based on the buy-sell agreement. The long waiting period is to give the business owner time to recover and return to active participation in the business, if possible. Benefit and benefit period. The benefit period for a disability buyout policy is typically only 1 day, but can be up to 10 years or age 65. The benefit is paid at the end of the waiting period to the business owner or business itself. It may be paid in a lump sum, installments, or a combination of the two. Coverage amount. Coverage is available up to $2 million. Features of the policy. Disability buyout contracts are conditionally renewable and non-cancelable. The premium cannot be changed by the insurance company. The policy must be offered for renewal up to the age specified in the policy or until a specific event occurs, such as the insured leaving the company. Benefits can be reduced after the insured attains a specified age, such as age 60. Increased by a future purchase option, FPO, to keep the benefit in line with an increasing business value. Termination of coverage. Coverage terminates when the insured is no longer an owner of the company or the company ceases operations. The insured may be able to convert some or all of the coverage to an individual policy without evidence of insurability. Financial need has to be proven. Tax treatment of premiums and benefits. Premiums are not tax deductible and they are not a taxable benefit to the insured. Benefits are tax-free. 5.5. Insurance to address the loss of a key employee. Disability insurance is typically put in place to protect the income of an individual in the event of a prolonged period of disability. However, the business employing that individual is an entity unto itself and the income of the business may likewise need protecting in case of interruption due to the disability of an employee. Key person insurance. Key person insurance protects the employer of the key person if they become disabled, critically ill, or dies. The policyholder is the business. The business receives the benefit of the policy. Who is a key person? As described in Section 5.2, a key employee is an employee whose activities are key to the success of the business and are very difficult to replace. This may as a result of producing sales and revenue, product development, or marketing or other essential skills. Purpose of the coverage. Key person insurance provides a benefit to compensate a business for the absence of revenue caused by disability of the key person. The key person is defined as a person whose skills and contributions are unique, and whose contribution is important to the success of the business. Key person disability insurance provides the employer with the necessary cash flow to offset potential losses to the business arising from the key person's absence from work due to disability. Various insurers place a maximum limit on ownership ranging from 10% to 50% before the individual is disqualified from key person coverage. The types of losses that the key person disability insurance is intended to offset are: decline in productivity due to the loss of key person's services, decline in productivity of other employees due to absence of support from key employees, decline in sales or networking contacts, costs of recruiting and training a replacement for the key person, if necessary. Terms of the contract. Disability of the key person uses the own occupation definition of disability. The policy is conditionally renewable. One condition is the continued employment of the key person by the business. Riders. Riders can be added to the policy such as the waiver of premiums, and recurring disability. A replacement expense rider may be available to cover the cost of hiring a replacement for the key person, if necessary. Benefits. The maximum benefit is the salary of the key employee to a limit of $15,000 per month. The addition of riders, such as a replacement expense rider, may increase the standard payout. Waiting and benefit periods. The waiting period for a key person insurance policy is usually 30 to 90 days. The benefit period is no more than 12 months. The employer will likely have to find a replacement if the insured is going to be off work for more than a few months. Tax treatment of premiums and benefits. Key person disability policies are usually owned by, paid for and payable to the employer. Premiums are not tax deductible. Benefits are received tax-free. Example: Signs and Lines is an incorporated business with 2 co-owners and 3 full-time employees. The company is in the business of designing and installing logos, signs and decorator artwork for commercial enterprises. Mona, their graphic designer, is responsible for 45% of the company's annual revenue, with about $300,000 of receivables attributable directly to her annually. The 2 owners are involved primarily in management and promotion, and the 2 other employees handle production, framing and delivery of goods. Realizing that the business depends heavily on the services of Mona, the owners have taken out a key person disability policy on her life, with a 60-day waiting period and a 12-month benefit period, paying $12,500 a month. This would be sufficient to cover overhead and salary expenses for the 2 other employees, to at least keep the business operating if Mona were to be disabled for a prolonged period of time. 5.6. Other types of business insurance plans. Other types of business insurance plans may also be known as health spending accounts or healthcare spending accounts. Although these are not business insurance in the sense that they do not insure the interests of the business or the business owner, they warrant brief consideration here. Each type of health spending plan pays benefits to the employees. Health and Welfare Trusts, HWTs. A health and welfare trust, HWT, is an alternative to a group health insurance plan. HWTs are trust-deed arrangements funded for the sole purpose of providing the employees with health care benefits. The HWT typically provides employees increased flexibility in the choice of benefits than can be found under a typical group plan. Specific requirements for an HWT are outlined in the Canada Revenue Agency's Interpretation Bulletin 1985 R2, Health and Welfare Trusts for Employees, dated July 31, 1986 and modified January 1, 1995. Contributions to the trust. Contributions are made by the employer only in the amount needed to fund the benefits of the trust. Income tax implications. Contributions are tax deductible for the employer, benefits are not taxable to the employee at any time. Employee Health Trusts, EHTs. Employee Health Trusts, EHTs, are a variation of HWTs. Employee health trusts are complex plans used by medium to large employers. Contributions to the trust cannot revert to the employer and must be used to provide specified benefits for the employee and family, such as paying premiums for individual or group health insurance. Contributions are tax deductible for the employer, benefits are not taxable to the employees. Unlike HWTs, the trust that administers an EHT must be resident in Canada. Personal Health Spending Plans, PHSPs. Also known as Private Health Services Plans. Used by sole proprietors, partners and their families for healthcare benefits. An administrator is appointed to collect contributions. The contributions are used to directly pay healthcare expenses. Contributions have a specified maximum. They must also be spent for services within 2 years. Contributions are tax deductible for the employer, benefits are not taxable income. Most PHSPs include travel insurance coverage and an exceptional expense rider to cover such items as a semi-private hospital room. Group disability or critical illness plans. A grouped plan is an alternative to a group plan when there are too few employees for a proper group plan to be provided. The employer agrees to acquire, fund and hold disability, accident and sickness, and critical illness contracts for the benefit of 2 or more employees. Benefits claimed under the policies are paid directly to the employees. The grouped plan is restricted to a class of employees and each member of the class receives similar benefits. If the group is comprised exclusively of shareholders, the plan will lose its tax status, in which premiums are deductible to the employer and the employer-paid premiums are not taxable income for the employees. Shareholders may be members of a group with employees. If the plan is properly structured, contributions are tax deductible for the employer, benefits are taxable income for employees. Example. The XYZ Corporation established a group disability plan for its office staff in 2011. The plan, in turn, purchased individual disability income replacement policies on the lives of each of its employees. In respect of one employee, Hans, the company paid $800 in premiums in 2012. The company was able to tax deduct the full $800, but Hans did not have to report a taxable benefit for the premiums paid in 2012. In 2013, Hans received $3,600 in income replacement benefits from the plan when he had to be off work for several weeks due to a severe knee injury sustained while playing football with some friends. Hans had to report a taxable benefit of $3,600 in 2013 as a result of the disability claim. 5.7. Taxation of benefits. The benefit of a business-owned life insurance policy may be paid to the capital dividend account of the business. It may then be distributed as dividends. Taxable income for the employee is created only when the benefit is paid by AHWT and EHT. Otherwise, taxation issues are addressed in the preceding slides within each section. See Table 5.1. Which provides a summary of the income tax implications to the employer and employee arising from the payment of premiums and receipt of benefits under business use DI policies. 5.8. Integrating business and personal disability coverage. Health insurance coverage is available through government plans, such as Canada Pension Plan, which provides disability insurance coverage. Personal insurance policies as a health insurance policy or a rider on a life policy. Groups, such as an employer. A business for business owners, partners, and shareholders. The agent must analyze coverage from all sources to ensure there are no duplication of service and expense, and no needs that remain unfulfilled. The all sources maximum must be respected. It limits coverage from all sources to no more than 85% of pre-disability income. Owner's need for personal insurance. Gaps or overlaps may occur when the client is the owner or operator of a business, particularly one with employees. Coverage levels and waiting and benefit periods need to be coordinated to avoid any gaps or overlaps in coverage. A disability program focused on protecting the employees would do little or nothing to cover business expenses, generate profits, or protect the net income of the business owner. A sole proprietor with a personal income replacement disability policy might find his income sufficiently provided for in the event of a prolonged disability, but if his business and employees are not also protected, the proprietor might not have a source of income to return to when he recovers. Example: Carly is a co-shareholder in an incorporated business with 30 employees. She has 3 co-owners. The company has key employee coverage on its owners, to ensure the viability of the business in the event of a prolonged disability. It also holds disability buyout policies on the lives of each, to fund a buy-sell agreement. The buyout policies have a 12-month waiting period, so the firm has also taken out disability policies on the shareholders, paying a benefit equal to 50% of their net income, to help the owners maintain their lifestyle during the period between the onset of disability and the triggering of the buyout. The contracts are owned and paid for by the corporation and are payable to it, which would, in turn, pay salary continuation to a disabled owner or operator. The plans have a 90-day waiting period and a 9-month benefit period. Since the disability benefits paid to Carly would be taxable, the after-tax income would be insufficient to fully sustain her during a year of disability. She needs to consider taking out a personal DI policy to supplement the coverage provided by her company. Her personal policy might have a waiting period of as little as 30 days and a 12-month benefit period. The level of monthly benefit should be in the range of $10,000 a month for the first 60 days, when no income would be coming from the company plan, and $5,000 a month, $60,000 a year, for the balance of the 12 months. If Carly was to remain disabled, long-term, coverage would not be necessary after 12 months, as her interest in the company would have been bought out under the insurance funded by our sell agreement. Additionally, it is important not to over-insure the business or the business owner. The majority of plans will include an all sources maximum built into their benefit schedule, capping benefits from all plans at 85% of pre-disability income. Chapter 6, Client Profile. 6.1. Personal situation of the client. An agent must analyze the client's situation to determine the client's risks and needs. The client profile should cover the following aspects: personal situation, financial situations, including income and expenses, insurance situation. An accident and sickness insurance recommendation will be based on the conclusions of that analysis. The following personal details need to be taken into consideration during a fact-finding interview. Personal factors unique to the client such as age, gender, and any hobbies. Marital status of the client. Dependents, if any, of the client. Client's occupation. Current health and health history of the client and their family. Client's retirement goals. Personal details. How do personal factors relate to insurance need? Age, gender, sports, hobbies, activities and pursuits have a direct bearing on risk. The probability of disability increases with age. It is also higher for women at all ages. A spouse may contribute alternate sources of income. Dependents need financial support in the event of the client's disability. Women live longer and, therefore, have a need for long-term care insurance that exceeds the needs of men. High-risk activities such as extreme sports require careful assessment since they can make an individual uninsurable, or insurable only with an exclusion. Given that disability insurance is income replacement insurance, the analysis must take into consideration how long the insured expects to work before retirement. Marital status. The agent should determine whether a client is currently single, married, living common law, or has previously been married or in a common law relationship. The client's marital status will have an impact on sources of income and expenses during periods of disability or illness. Financial obligations are greater for those who are married, whether the marriage is legal or common law, than for those who are single. Married individuals must take into account any financial obligation they have to their spouse and dependent children. This obligation may be reduced by the income earned by the spouse. There may also be support obligations for a former spouse and children. A single person incurs the risk that comes with being alone, no one to provide care during disability, critical illness, or old age. A single person may need money to buy services that a married person might receive from a spouse. Example: Henri is single and earns $60,000 a year and would require 60% of his current income to survive during a period of prolonged disability. If he had no other source of income or income replacement, he would need $3,000 a month of disability insurance to support him during a period of disability. $60,000 times 60%, divided by 12. Henri's brother, Jacques, and his wife, Marie, each earn $60,000 a year and would require 60% of their combined incomes, or $6,000 a month, to live if either of them was to become disabled, calculated as $60,000 times 2, times 60%, divided by 12. However, in the event of Jacques' disability, Marie would still be earning $5,000 a month, and vice versa, leaving a shortfall of only $1,000 a month should one of them become disabled and unable to work. Each of Jacques and Marie might only require $1,000 a month of disability insurance to protect the family in the event of the disability of one or the other, although a higher level of coverage would likely be prudent. To guard against eventualities, one spouse might need to work part-time to help to care for the other. Dependents. Who depends on the client for support? Who might depend on the client for support in the future? Dependents may include a spouse, during a period of disability or later in life. Children, before they become financially independent of their parents. Other family members, including parents or siblings. Occupation. The risk of the client's occupation will determine types of disability policies that can be offered, the policy waiting period, the benefit period, the premium. Note that knowledge of a client's occupation is important in terms of insurance. However, the amount of critical illness and long-term care insurance required is not primarily determined by occupation. Duties. Occupations are classified according to their risk of disability. Risk relates not only to the physical environment, hazardous conditions, noxious chemicals, etc., but also to the amount of exertion and stress to which the person is exposed. The duties of an occupation will also impact the insurance offer. Underwriters examine the physical requirements of the job, length of the work week, and annual vacation allotment. Work history. It is helpful for the agent to know his client's work history. For example, some jobs, such as mining, could potentially lead to postponed physical ailments. Has the client worked in a more hazardous occupation than currently? How long? How frequently does the client change jobs? Future work plans. Does the client plan to change jobs soon, or retire? A new job may present a different occupational classification. The amount of income the client earns from their work may change, and if so, this change will affect the benefit needed. Health. Health conditions indicate a need for accident and sickness, A&S, products. However, issues arising from health issues or concerns may limit policies and their benefits. For example, current or past health problems could lead to illness or injury, resulting in disability claims. Health factors such as diabetes, hypertension, or smoking are risk factors for heart attack and stroke, which could lead to a claim under a critical illness policy. Factors like diabetes could lead to other debilitating conditions, which may require facility or home care under a long-term care policy. Those with health problems are likely to have increased numbers of claims and medical expenses under an extended health care policy. Personal health history. Risk assessment is based on the applicant's health history, including any past disability claims. The medical underwriting questionnaire of A&S coverage places importance on the applicant's present and past state of health. If the client's medical past is too complicated, the client might be subject to severe coverage restrictions. Full details about any former disability claims must be provided during the underwriting process. Family health history. Risk assessment also looks at the applicant's immediate family for conditions that may be prevalent or genetic. Longevity may be a limiting factor for long-term care insurance, since a longer lifespan would indicate a higher probability for care, and over a longer period. Particularly in CI or LTC insurance, prevalent or genetic family risk factors would likely lead to a restriction of coverage and/or benefits, or a decline of coverage altogether. Retirement goals. When the client plans to retire is an important factor for an agent to consider when the agent designs an A&S insurance program. The scheduled retirement date determines how long benefits would be payable under a disability income replacement program. Travel and living abroad or living at home. The quality of retirement life that the client anticipates dictates the A&S program design, particularly in respect of critical illness and long-term care insurance. If the client plans to travel extensively in retirement, there may be an increased need for critical illness and long-term care insurance. If the client is planning on living abroad for extended periods every year, for example, winters in Florida, their situation will call for travel insurance, health insurance, and long-term care policies. Health costs in a foreign jurisdiction might be much higher than in Canada. 6.2. Client income. There are many sources of income to consider. Bear in mind that the purpose of reviewing all client income sources, both earned and unearned, is to understand where money comes from, its amount and dependability, and whether it will continue during a period of disability or illness. The client's income is a less important factor in assessing the need for CI and LTC insurance, since the products are intended to provide benefits to pay for expenses, not replace income. Sources of earned income. For the pre-retirement client, aside perhaps from investment income, income from employment or self-employment will be the mainstay of providing for living expenses, savings and investments. etc. It is critical for the agent to be able to identify not only the source and amount of employment income but to assess its consistency and future viability. Salary, bonuses and commission income from working. It is important for the agent to obtain a breakdown of earned income from the client and distinguish between salary earned by the client, bonuses, and commission income. Salary is most stable and predictable. Bonuses and commissions may be highly variable and undependable, and hence, the consistency of bonuses and commissions needs to be assessed. Income from commissions should be looked at over several years to determine its consistency. Business income. Business income must be examined for consistency. If the client works for himself, in partnership with others, or as an employee with one organization but also has additional sources of earned income, the agent should look into details of the business itself and the history of the non-employment income sources to assess the viability and consistency of the business income stream. If business overhead insurance will keep the business afloat during a disability, the need of the business owner for an individual policy must be taken into consideration. Sources of unearned income. When considering a client's overall sources of replacement income, or income to defray medical or care expenses, earned income is generally the first thing that an agent will review. Passive income must also be taken into consideration, income available to the client even when he is not working. Passive income could include income earned by other family members, investment income, income received as the beneficiary of a trust or sources of cash flow that are not strictly income but which could be utilized as a substitute for income. Income earned by spouse. The spouse's income contributes to income needs of the couple or family and may continue during disability of the other spouse. Spousal income may be reduced if the spouse must take time away from work to care for the disabled spouse. Investment income. Investment income, interest, dividends and capital gains, may be earned on either registered or non-registered investments. Income earned in a registered account, such as an RRSP, does not contribute to pre-retirement cash flow. Investment income from non-registered accounts contributes to income before disability and will continue after disability. Any investment that can be converted from an accumulation mode to payout mode in case of emergency may need to be factored into an income replacement calculation. Allowance also needs to be made for market downturns, when investment values might be depleted and it is not advisable to liquidate assets. Support payments. A divorced or separated client may be in receipt of either spousal or child support payments or both. These payments would be a factor in calculating both pre-disability and post-disability income, since payments to the client would still be payable regardless of whether the client was disabled, had suffered a critical illness or was in need of long-term care. It is important to know how much the payments are, whether they are taxable or tax-free income, how frequently they are paid, and for how long into the future they will be payable. Support payments could be a critical income source as part of the overall plan. As such, in the planning process it is important to consider is the payer's long-term ability to make those payments if the payer was to become disabled. Pension income. Pension income, government, corporate or private, can be a source of replacement income for a disabled earner or a resource to help defray the costs of a critical illness or long-term care. In the case of the pre-retirement client, it is important to ascertain what sources of pension income can be available in the future, when the pension can begin and how much would be payable at different start dates. Should the client become long-term or permanently disabled prior to retirement, future pension income could replace much or all of his income lost to disability. The amount of disability income replacement benefit would then be the amount required to fill the income gap between the date of a possible disability and the dates that the client's pensions could commence. Royalties and other income sources. Similar to investment and pension income, ongoing royalties and residuals for work or works performed in the past continue to be paid regardless of the client's ability to work in the present or the future. These payments must be taken into consideration in calculating the client's current and future income. The agent should also inquire as to the possibility that the client is, or will be in the future, the recipient of income from a trust or estate established by a grandparent, parent or other family member or individual. If such funds are being received currently, it is important to ascertain the amount of trust income received annually, the frequency of payments and the future duration of the payments. Example: Clarence is named as income beneficiary for his father's estate, with the capital residue of the estate to be paid to Clarence's children at his death. At present, Clarence's father, aged 78, is alive and relatively healthy for his age, so no income is forthcoming from the estate to Clarence, nor is it known when such income might commence or how much it might be. Such speculative income cannot be factored into Clarence's estate and financial planning, but its potential existence still should be recorded as part of an overall review. Disability income. The client's existing sources of disability income benefits must be taken into consideration when assessing the need for additional coverage. Existing sources of disability income could be private insurance plans, group plans, or government plans like CPP or the Quebec Pension Plan, QPP, and workers' compensation and employment insurance. Details can be obtained from policies, group benefits booklets, Service Canada or provincial agencies responsible for managing government plans. In-kind income. In-kind income is income offered on an exchange basis for unpaid services instead of cash, for instance, from a stay-at-home caregiver. Contribution to elder care from stay-at-home caregiver. In the case of a client in need of in-home care due to illness, injury or the effects of aging, the care services of a living family member can be considered to be a form of income. The care provided for free replaces professional services. Such care could be in the form of cooking, cleaning, bathing or other personal or household services that the client might not be able to perform for himself. The income provided by such services is indirect, the free care eliminating expenses that would otherwise be paid to a third party. Community programs. Many services are provided by publicly funded agencies and their value can be considerable, including in-home care, rehabilitative care at community centers, Meals on Wheels, and like services available in the client's community. The simplest way to find information about the types of service available to the client is through an organization like the Community Care Access Centre, CCAC Ontario. The CCAC can provide contact information for such services and for visiting health professionals, including nurses, physiotherapists, occupational therapists, speech-language pathologists, dietitians, pharmacists, respiratory therapists and social service workers. Other sources of income. The concept of income is classically defined as the money or other gain periodically received by an individual, corporation, etc., for labor or services, or from property, investments, etc. However, in times of need, personal savings and assets can also contribute to cash flow needs. Emergency funds and other assets. An emergency fund is recommended to cover 3 to 6 months' living expenses. If money has been set aside for emergency purposes and to help cover extraordinary expenses, it can be factored into the plan for benefits. Other assets may not be expressly designated as an emergency fund, but, if they can be accessed quickly and with little or no negative tax consequences, they could also fulfill the role of, or augment emergency funds. 6.3. Client expenses. It was noted previously that disability income would be based on replacing 60% of the insured's active income from working. An alternative approach is to base the benefit on actual living expenses if they are lower than the 60% threshold. For instance, replacing income could require $5,000 per month of benefits. However, expenses are just $2,500 per month. Therefore, the disability benefit could be based on the lower sum and carry a lower premium. Critical illness benefits are a best guess estimate of what the insured might need, or want, in the case of serious illness. The insured must be able to afford the premium, as his cash flow will attest. Coverage for long-term care insurance is hard to estimate. Premium affordability will be key. Bear in mind that the purpose of reviewing all client expenses is to understand how much is required in a benefit or benefits, and when it is required. Example: Sophia is a freelance translator and earns on average $60,000 of pre-tax income annually. Her portion of family expenses such as mortgage payments and groceries amounts to $2,000 a month. Because she would not be able to continue obtaining contracts if she was to become disabled, she wishes to purchase disability insurance. Based on an income approach, her agent could recommend monthly benefits of $3,000, that is, 60% of her pre-tax monthly income, $60,000 divided by 12, times 60%. Based on an expense approach, her agent could recommend monthly benefits of $2,000. Both would be appropriate, and the final decision would have to take into consideration other factors, such as affordability. Living expenses. Living expenses to be covered by a disability income or critical illness policy are the expenses incurred by living, housing, food, clothing, vehicle expenses, and so on. When a budget of living expenses exists, it will be far easier to estimate insurance coverage needs. Mortgage statement or rental agreement. A client's mortgage or rent payments are usually the largest single monthly expenditure. Thus, the amount paid and mortgage duration is key to living expenses. The agent must explore the client's terms of the mortgage or rental agreement to understand how this expense will be impacted by a period of disability or illness. Bank statements. Bank statements over a period of a year indicate the client's expenses and spending. The bank statements will indicate the minimum amount required to maintain the client and his family along with the family budget. Net worth and income and expense statements can be used instead of bank statements to show spending. Budget. A family or individual budget is helpful to show how money is spent, which expenses are mandatory and which expenses are optional. Expenses are allotted to categories such as housing, food, entertainment, and others limited to the individual, such as a club membership. Accuracy in determining expenses is important to determine coverage amount and duration. The following example shows a sample budget indicating the types of income and expenses that should be tracked on a monthly basis. Savings and investments. Saving and investing are a double-sided coin regarding cash flow during periods of disability or a debilitating illness. The client's savings and investment accounts can be used to substitute or supplement current income if earned income is reduced due to disability. Nevertheless, if the client typically contributes to these plans, he may wish to continue the contributions, even during periods of reduced income. This guarantees the accumulation of sufficient retirement income or wealth for his estate. These plans could also be seen as a liability, with the contributions being a cash drain, similar to other personal and household expenses. The best way to establish the nature and extent of savings or investment plans is to review the client's documentation and statements regarding registered investment accounts, non-registered investment accounts, pension plans, life insurance, registered investment account statements. The client's RRSPs and TFSs can be a source of capital to replace lost income or pay extraordinary medical or care expenses. Statements for registered investment accounts can show the character of individual investments, sums available, their liquidity, ability to be sold and turned into cash, maturity dates, and surrender charges. Of course, in the case of RRSPs or registered retirement income funds, RIFs, allowance would have to be made for tax payable on withdrawals if consideration was being given to surrendering part or all of the accounts to supplement lost income or to pay medical or care bills. It should also be kept in mind that both capital investments and accrued income can be withdrawn from a TFS tax-free. In the case of RRSPs and registered retirement income funds, RIFs, if a sum is withdrawn from the registered account, there will be a withholding tax plus the balance of the sum must be declared as taxable income. The TFSA, tax-free savings account, is an exception, there is no tax applied. A registered disability savings plan, RDSP, can provide income for a person who is disabled and receives the disability tax credit, DTC. A person who is the beneficiary of an RDSP would not qualify for disability or other health insurance. RDSPs are registered plans approved by the federal government to provide qualifying disabled beneficiaries with a tax-deferred savings program and support payments in their later years. A disabled person is eligible to be a beneficiary of an RDSP who is eligible for the disability tax credit, disability amount, is a Canadian resident, is under 60 years of age. If 59, the individual must apply before the end of the calendar year in which he turns 59, and has a social insurance number. Contributions are not tax deductible. There is no annual limit for a private contribution to a plan. In 2014, the lifetime private contribution limit for an RDSP was $200,000. The federal government may pay a matching Canada Disability Savings Grant, depending on the amount contributed and the beneficiary's family income. The government may also pay a Canada Disability Savings Bond into the RDSPs of low-income and modest-income Canadians. Investment income earned in the plan accumulates tax-free. However, grants, bonds and investment income earned in the plan are included in the beneficiary's income for tax purposes when paid out of the RDSP. Non-registered investment account statements. Like registered accounts, non-registered investment account statements will show the type of investments and sum invested. Sale or surrender of investments held in the account may result in immediate tax charges. The statements from the account manager or fund should provide the current ACB for the client's account or investments, facilitating the calculation of capital gains reportable upon surrender of assets. Pension plan statements. A pension plan is a valuable asset to its owner. A client's pension plan may be a source of income to supplement earnings lost to disability or to help to pay medical bills or the costs of long-term care. Statements are provided to the owner annually confirming the value of pension savings, when the pension may begin, and how much will be received based on pension savings and age at retirement. Life insurance statements. Cash value life insurance can also serve as a valuable asset. The client is likely to be able to provide both the policy itself and the most recent annual statement from the issuing insurance company. Life insurance statements will disclose the premium and frequency to which it is payable, that is, monthly. The most recent policy dividend, in participating whole life policies, and the cash surrender value, CSV, of the policy at the last anniversary. Life insurance policies will show if the contract provides periods during which no premiums need to be paid to the policyholder, that is, premium holidays, and if there is a waiver of premium rider in place that would eliminate the premium expense after a 3 to 6 month period. Cash value life insurance could be a source of cash flow during emergencies in the following ways. Annual policy dividends paid to the policyholder. The cash value could indicate an amount available as a policy loan. Premium holidays which lead to a reduction in expenses, and waiver of premiums during disability. Debt. Debt load is the amount a person owes and is of particular interest to an insurance agent for the following reasons. Debt is typically paid on a monthly basis and is therefore very important to the budget and amount of cash flow needed in the event of disability. Debt requires regular monthly repayments, and ideally full repayment before retirement, and a large debt load reflects on the insured's ability to manage cash and tolerate risk. Personal line of credit and home equity line of credit, HELOC, statements. The client may have an unsecured personal line of credit with his financial institution and/or a home equity line of credit, secured by his home. These credit lines are amounts that the client can draw upon at any time. These statements show how much can be borrowed, how much is borrowed, and the minimum monthly payment required to keep the account in good standing. Their cost of borrowing is far less than credit cards. Available balances can be used for credit card repayment to improve cash flow. As with credit cards, the unused portion of personal lines of credit can, in extreme cases, be regarded as a source of emergency funds. Credit card statements. Credit cards are available from different sources such as banks, credit unions, retail stores and gas stations. Most clients will have at least one credit card. A credit card statement will show how much can be borrowed, how much is borrowed, and the minimum monthly payment required to keep the account in good standing. The simplest way to review the status of a client's credit card accounts is to examine his 3 most recent monthly statements. This will demonstrate how often the client uses the cards, the level of purchases normally made, the average monthly payment, whether the client discharges the balance in full each month and the credit limit. If not, the most recent statement would provide information regarding the current balance on hand and the interest charged on the balance. Some cards provide accidental death insurance, job loss protection, and travel insurance, which will be outlined in the statement. Tax liabilities. Tax may be due or owed for. Income tax as shown in the income tax return, in Quebec, the provincial income tax return. Corporate income tax. GST or HST as shown in the GST return. Residential rental, or vacation property tax. Other liabilities. The client may also have support obligations to a spouse or dependents, lawsuits that will require settlement, or the desire to support family members, such as parents. 6.4. Financial situation of the client. Gathering all the foregoing information is intended to reveal whether the client has sufficient resources to cover the loss of income for 1 year. The client has sufficient resources to pay the expenses of a medical emergency lasting 1 year. Net financial position. Net worth is determined as assets minus liabilities. However, many factors will impact the value of assets, such as whether a forced sale of an asset would result receiving a lower value. It is important for the agent to ensure the approach taken is consistent throughout his analysis to produce a coherent recommendation. Review of assets. A net worth statement will ideally list all assets, rather than cash flow, valued at their current fair market value. The agent must determine what assets are currently available, that is, they could be converted to cash within 12 months. Certain assets, like the family home, should not be considered saleable assets because they cannot be converted to cash immediately. Review of liabilities. The liability statement would include such items as mortgages, bank loans, credit card balances and unpaid taxes. Liabilities are examined to determine current and long-term obligations. The agent should determine if the client, in the event of a disability or medical emergency, has sufficient resources to cover his income loss, medical and all care expenses for at least 1 year. The following example presents a sample format for a standard net worth statement. Example. Net worth statement for John and Jean H. Home. $526,000. Cottage. $360,000. 2 vehicles, owned. $40,000. RRSPs. $105,000. TFSA. $3,300. Life insurance CSV. $22,000. Cash. $7,100. Total assets. $1,063,400. Liabilities. Mortgage home. $112,000. Mortgage cottage. $86,000. Line of credit. $23,600. Credit cards. $8,900. Car loans. $5,300. RRSP loan. $4,400. Total liabilities. $240,200. Net worth, assets less liabilities. $823,200. Cash flow statement. The cash flow statement lists net income and all expenses, including debt liabilities. If income is more than expenses, then cash flow is available for disability or medical expenses. Details on expenses will illustrate which could be curtailed so that insurance premiums can be paid. The cash flow statement can be developed for a period of time as long as a year or as short as a month. It is most accurate when it is backed up with a budget based on actual spending patterns. The following example illustrates a cash flow statement drawn up over a period of 3 months. See table in this section for example of cash flow statement for John and Jean H. 6.5. Insurance situation of the client. The next step in the agent's assessment of the client is to assess the insurance coverage already in place, if any, and compare the current coverage with his client's overall needs. Personal and/or group coverage in place. A&S insurance is available in many forms such as individual policies, group insurance coverage and protection associated with debt, etc. The agent should know the client's current type and amount of coverage as well as the character of the client's coverage. Type of policy or policies. Insurance in place will be provided by various sources, such as the following: individual personally, lender-owned and corporately owned policies, and group insurance from an employer or another group plan, that is, an association group. An employer's group plan could terminate without rights of conversion when the plan member leaves the employ of the employer. Association coverage will not. Depending on the source of the coverage, there may be inherent limitations on the coverage provided. Benefits range from: monthly income is provided by a disability income insurance policy. Monthly reimbursement is provided by a business overhead policy. A lump sum for disability buyout. Reimbursement of costs for extended medical. A lump sum for critical illness. Monthly payment for long-term care. Characteristics of coverage. The agent should list each form of coverage for the client and its characteristics, such as benefits, duration of benefits, tax status, definition of disability and when coverage terminates. Comparing all characteristics will show the current and future needs for insurance. Cost of coverage. The cost of coverage will vary by type of policy. For example, a group benefit will cost less than individual coverage. A client should not duplicate coverage if it causes benefits to exceed the all negation source's maximum. Financial resources should be directed to the most critical need first. Government coverage. In Canada, the federal and provincial governments have multiple benefit programs in place for participants who cannot work due to injury or illness. The following discussion provides an overview of the benefits available from these various government-sponsored plans. It is important for agents to stay up to date on the current contribution and benefit levels as well as eligibility requirements. Note that the features of government plans may be updated on a regular basis. Employment insurance, EI. Employment insurance, EI, formerly known as unemployment insurance, UI, is provided by the federal government to those who have worked at least 600 hours in the previous 52 weeks, have lost at least 40% of their income due to illness, injury, or quarantine. Benefits begin on the 15th day after disability. The benefit period is 15 weeks. Thus, EI benefits will not likely be a major portion of most clients' disability program. EI is a second payer to other sources of disability benefits, such as group insurance, CPP, workers' compensation, except personally owned policies. For example, if a benefit is paid by a group plan equal to the EI benefit, nothing is received from EI. EI contributions are based on the employee's eligible income and are made by the employee and employer. Self-employed individuals pay 100% of the contribution. Employers can deduct contributions from tax. Benefits are taxable income. Canada Pension Plan, CPP, or Quebec Pension Plan, QPP. The Canada Pension Plan, CPP, and Quebec Pension Plan, QPP, offer disability benefits to plan members under the age of 65. The CPP is a contributory plan provided by the federal government to those younger than 65 who have made either a CPP contribution. The QPP replaces CPP in Quebec. Disability must be severe and prolonged to receive the benefit. A severe disability prevents work in any capacity. A prolonged disability is long-term and usually results in death. Both conditions must exist. There is a 3-month waiting period. Contributions are based on qualifying income and are made by an employee and an employer with a 50-50 shared contribution. Self-employed workers pay 100% of the contribution. Employers can deduct contributions from tax. Benefits are taxable income. At 65, the disability pension transitions to the retirement pension. The CPP and QPP determine a maximum for both the disability benefit and retirement benefit. Workers' compensation. Funded by employers for their employees. Administered provincially, benefits vary by province. Benefit received is typically 80% to 90% of pre-disability net income. Employers can deduct contributions from tax. Benefits are tax-free. Tax treatment of contributions paid and benefits received under government programs. The tax treatment of contributions paid and benefits received under the 3 public insurance and pension plans varies by type of plan and with who is the payer of the contributions. Tables 6.1 and 6.2 provide a brief summary of the tax rules. Table 6.1. Taxation of contributions paid for government programs. Employment insurance. Shared by employer and employee. Deductible by employer for the employer portion. Qualifies for tax credit for the employee portion. CPP or QPP. Shared by employer and employee. 100% paid by the self-employed. Deductible by employer. Qualifies for tax credit for the employee portion. Workers' compensation. Employer. Deductible by employer. Not a taxable benefit to employee. Table 6.2. Taxation of benefits received from government programs. Employment insurance. Taxed as income. CPP or QPP. Taxed as income. Workers' compensation. Tax-free to the recipient. 6.6. Client profile finalized. The recommendation is finalized based on personal needs, client financial situation, and existing insurance coverage. The analysis of existing insurance coverage will show coverage meets needs. Coverage exceeds needs. Any overlap in coverage between sources. Coverage is inadequate for needs. Benefits may be inadequate. Waiting periods may be too long. Benefit periods are not long enough. Unsuitable restrictions. The agent will address inadequate coverage in his recommendation. Chapter 7, Insurance Recommendation, Contract and Service Needs. 7.1. Insurance Recommendation. The following steps come after fact-finding, as described in Chapter 6. An agent has a duty of care to develop recommendations that are suitable to the client's needs and to present the recommendations in a way that ensures the client understands the nature of the problems and the solutions offered, so the client is able to make an informed decision. An insurance recommendation is based on the underlying reason that has been identified for insurance, how premiums can be managed, whether there are modifications imposed for non-standard risks, the quotes for the insurance documenting the recommendation, a review of available policies, whether the recommendation requires revision based on client feedback. The recommendation and all supporting information should be filed in a client's documentation file, an important resource for answers in the future. Basis for the recommendation. Using the client profile, the agent identifies opportunities for an insurance recommendation. Existing policies should be reviewed first to see whether changes could be made that will bring them in line with identified needs. Failing that, new policies are recommended. Recommendations to manage premiums. A and S premiums are often higher than clients expect. Creative thinking may be required to bring premium costs down in order to secure a client's commitment to purchase. Extending waiting period, shortening benefit period, reduced benefits. The premium can be reduced by a longer waiting period, a shorter benefit period, a lower benefit. Care must be taken while increasing the waiting period or shortening the benefit period to ensure that the new extended waiting period will still allow the client to manage till the benefits begin, or that the shortened benefit period would meet the client's needs considering the uncertainty of the duration of a disability or a need for care. Usually, the option of reducing benefit is a last resort solution. Head office modifications for non-standard risks. Risk of the insured will be classified by the underwriting process as standard, non-standard, uninsurable. Non-standard risks can become insurable if exclusions are imposed. For example, a disability claim arising from skydiving will be excluded. Limitations are imposed. For example, the benefit period of the policy is limited to 5 years instead of the 10 that was applied for. The premium is rated, that is, increased. A deductible is applied to claims. For example, an extended health plan could be offered with an annual deductible. Usually, the client gets to know of these specific changes to the policy as applied for when the policy is issued. The agent must explain these changes during the delivery of the policy. Suggesting exclusions, limitations and ratings. Exclusions and limitations are both elements that the insurance company might integrate into the contract being offered to the client to limit the insurer's otherwise excess risk exposure with a non-standard life. A rating is simply applying a premium to the contract that is higher than would be warranted if the applicant was rated standard. The higher premium allows the insurer to build up a higher reserve, to help offset the higher risk of having to pay benefits. Suggesting deductibles. An alternative, or complement, to modifying the benefits available under the plan is to require the insured to share in the cost of the covered treatments or benefits otherwise payable by imposing a deductible, that is, an amount of the claim that must be paid by the insured before any benefits are forthcoming from the insurance company. Deductibles would be most common in extended health plans, plans which would normally require the insurer to pay, or reimburse the insured for, covered goods or services. Instead of being covered for the first dollar of claims, the insured is required to cover a dollar amount of the covered items himself, usually with a new deductible being applied each coverage year. In this way, the insurance company's exposure to payouts is somewhat reduced. Example: Elvira's Group Extended Health Insurance Plan offers coverage of up to $2,500 a year for preventative and restorative dental services, after allowing for a $200 annual deductible per calendar year. Elvira's first claim this year was $300, for X-rays, cleaning and one filling. She had to pay the first $200 herself, under the deductible, and was reimbursed the additional $100. For any subsequent dental claims during the same calendar year, no deductible would apply. Providing quotes. Quotes can be presented to the client for a single best choice product solution. The agent researches the market and makes product comparisons in order to determine the best product solution in line with the client's needs. He then presents this best option to the client based on his research. The agent should maintain a record of his research and the reasons behind his final decision. The recommendation, in this case, is final and the client decides whether to accept the recommendation or not. Two suitable but different solutions. The client is involved in the decision-making process based on the agent's preliminary research. The agent's role will be to compare competing product similarities and differences. Which route to take is a matter of personal choice of the agent, but the agent who offers complementary choices must prepare a clear comparison that highlights the main points of each policy. The agent should focus on the similarities and differences between the policies when making his comparison. Trying to compare more than a few basic points may lead to the client not being able to make a decision. The agent can help him make an informed decision between the policies being considered once the applicant has a clear understanding of the elements of each contract. Documenting the recommendation. A client file should be opened from the very first contact between agent and client. All conversations and correspondence, both written and verbal, should be recorded in the file. Research about competing products should also go into the file. This is evidence that the agent has carried out his or her due diligence. Rationale for recommendation. Client expectations must be noted along with the rationale for the recommendation that was made and for those not made. It may be essential at a future date to be reminded of the reasons a specific course of action was not taken. For example, the reason we did not proceed with the critical illness policy was client's expressed desire not to buy the CI policy but to acquire more life insurance. Example: Agent Horst had to defend himself against a client complaint after another agent had reviewed the product that Horst had recommended, suggesting that Horst had not done due diligence in his research and therefore had not made the best recommendation for his client. In fact, Horst had compared 5 similar products that could meet his client's needs and recommended the one that he felt was the best fit. Horst had wisely kept copies of his product research and a grid that he created to compare the products from a variety of perspectives. These documents proved invaluable in defending the fact that he did his due diligence and made a valid recommendation. Client expectations. A client's expectations about his or her insurability may not match with the underwriter's assessment of the client's insurability. The opinions expressed by clients may lead to expectations about the insurance product and coverage details they think is most suitable, the risk they present, the premium they deserve. The client file should document these expectations and how the agent took them into consideration. If a policy is delivered that is significantly different than the client's expectation, the agent may want the client to sign a waiver acknowledging the difference. Presenting complementary policies. Because insurance products address specific needs, it is quite possible for a client to require more than one type of policy. For example, a client may need a disability income policy plus a long-term care policy. If it is not possible to proceed with the recommendation for multiple policies, the most pressing need should be addressed first. Example: Elijah owns a computer software consulting firm with 3 employees, 2 part-time employees and 1 full-time employee named Malik. Malik's services are critical to the success of the business. If this key employee was to die or become disabled for a lengthy period of time, business revenues would suffer significantly, perhaps to the point where the business would have to be wound up. At the same time, Malik has a wife and 2 children who are wholly reliant on him for their financial support. Elijah feels that the business could survive for at least 6 months without Malik's contribution, but his family would be in serious financial straits after only 60 days. The business would need replacement cash flow of $10,000 a month for up to 2 years, whereas the family would need $3,000 a month for at least 5 years if the disability lasted that long. It would appear that one disability contract would not meet the needs of both the business and the family, so Elijah's agent recommended that the company take out 2 policies, a key person disability contract for $10,000 a month with a 180-day waiting period, payable to Elijah's company, and a disability policy for $3,000 a month with a 60-day waiting period, payable to Malik. Revising the recommendation. If an initial recommendation is unsuitable, the agent must find ways to revise the recommendation to make it acceptable to the client, while ensuring that it meets the client's coverage needs as closely as possible. 7.2 Application for insurance. The application is the first step in the process of creating an insurance contract. Contracts are subject to contract law and imply a set of rights and obligations on all parties to the contract. A copy of the application should be placed in the documentation file. Attention to detail required. The application requires thorough and accurate answers to all questions, as underwriting of the application is generally based upon the answers provided. The agent must ask the applicant all questions on the application form, and record the client's answers completely and accurately. Inaccurate or incomplete information on the application could result in a delayed underwriting process or coverage being declined. From a practical and legal standpoint, the applicant and insured rely on the agent's expertise in regard to the interpretation of the questions being asked on the application and an explanation of the nature of the answers expected. How does the agent show the necessary attention to detail in the application? The agent correctly specifies the type of insurance and its coverage. The agent ensures the correct parties, that is, the policyholder, life insured, and beneficiary, are properly named under the policy. The agent quotes a premium to the applicant and stresses that it is preliminary and will be finalized after underwriting. The agent adds riders correctly according to the client's wishes and informs the client that underwriting for riders is separate from the base policy, and rider premiums will be in addition to the premium for the base policy. Naming of beneficiary. Most A&S individual policies name the same person as the policyholder, life insured, and beneficiary. Example. Concerned about not burdening his children financially, Andre is applying for a long-term care policy on his own life, to cover nursing home fees and other medical costs should he need care in his elder years. Andre will be the owner, the life insured, and the beneficiary of the policy. Business policies will be different. Often the business will be the policyholder. The life insured may be a shareholder, owner, or employee. The beneficiary may be the business, a shareholder, or an owner. Ensure the correct beneficiary information is stated so that premiums will be charged and benefits will be paid as the business expects. Ensuring the beneficiary information is correct is also important for tax reasons. Example. Hanif runs a privately incorporated business with 3 employees. He has struck different compensation arrangements with each employee and has taken out individual disability insurance policies on 2 of them, Alfred and Blanche, for different purposes. The policy on Alfred is a key person plan, designed to compensate the business for the loss of his services should he become disabled for a period of time. Hanif's business should be both the owner and the beneficiary of that policy. Neither the payment of premiums by the employer nor the payment of benefits, if any, to the employer would have a tax impact on the employee who is the life insured under the policy. A second policy, on the life of Blanche, is intended to replace her personal income should she become disabled, thereby relieving the business of any obligation to continue Blanche's salary even though she is not productive and contributing to business revenues. The business should be the owner of the policy. If Blanche is named as beneficiary of the policy, she should report the premiums that the business pays on the policy as a taxable employment benefit. Otherwise, the business could be named as beneficiary and use the policy benefits to replace the salary otherwise payable to a disabled Blanche. But in that case the entire benefit paid to Blanche would be taxable, not merely the premiums paid on the policy. Either outcome is acceptable, but Hanif and Blanche would need to know the tax consequences arising from the structure chosen. Agent's contribution to application. The agent should be proactive in the application process, asking for information that he knows the head office underwriting department may require, even if it is not specifically requested on the application. The agent may choose to record his thoughts from the client interview. Note that the agent may be the insurance company representative with whom the applicant has face-to-face contact. Thus, the agent's impressions and concerns are very important to the underwriting process. The agent intervenes in the following aspects of the application. Agent's comments, medical questions, inspection report, and hazardous sports and occupations questionnaires. Agent's comments. Agents are provided with a comments section on the application for extra information that cannot be answered with yes or no responses. Comments provided by the agent may be favorable or unfavorable to the applicant. For example, during the application process, the agent may notice that the client's clothes smell like cigarette smoke but the client claims not to be a smoker. An agent should draw the insurer's attention to it. Continuous exposure to secondhand smoke may have a lasting negative effect on a proposed insured's health, which could also impact premiums. It is essential for the agent to reveal any additional information that affects underwriting and acceptance or denial of the application. Medical questions. The agent assists the applicant with the completion of the non-medical form, a questionnaire that requires the applicant to respond to a series of questions about his and his family's health history, either in lieu of or as a precursor to undergoing a medical examination. Medical questions can prompt the agent to ask for extra details. For example, a medical checkup could be scheduled, that is, routine, or unscheduled, that is, due to a medical problem, and could result in tests, medical procedures, drugs or therapy. Simply knowing there was a medical checkup does not provide the full and accurate picture of the reasons for the checkup and its outcome. Example. A question on the non-medical form on an application asks, when was the last time you visited a doctor, and what was the reason for the visit? The applicant, who was also to be the life insured under the policy, answered, last July, for a checkup. The agent recorded the applicant's answer and moved on to the next question. However, this left a number of unanswered questions in the mind of the head office underwriter. Was this an annual or semi-annual scheduled checkup, or was there a specific problem that triggered the visit to the doctor? If the latter, what was the specific problem? What were the symptoms, if any? What did the doctor conclude? Were you subsequently sent for tests? If so, which tests? What feedback did you or your doctor receive? Was any medical procedure required? Were any drugs or therapies prescribed? What was the result of the treatment, if any? An answer simply recording the date of the applicant's last doctor visit might have satisfied the needs of the question, in its simplest form, but would not have satisfied the underwriters. Inspection report. An inspection report is ordered by the underwriter from a third party, for example input from the applicant's employer, neighbor, etc. It is used to provide details on lifestyle issues, such as participation in dangerous sports, hazardous sports and occupations questionnaires. If the applicant admits to participation in hazardous sports or works in a dangerous occupation, a separate questionnaire at the time of the application must be completed asking for details of the activity and how often the applicant currently engages in the activity and plans to in the future. The underwriter can choose to manage the risk with an exclusion rider or by denying the policy. Necessary documents and procedures. Health information and confirmation of income must be provided for individual disability insurance. Almost all types of insurance require the applicant to provide documentation in support of health, income or insurance needs, and perhaps to undergo special medical procedures. All types of business insurance also have similar requirements for documentation. Extended health care relies primarily on the health questionnaire. Medical exam. Medical evidence of insurability may be provided by medical tests and/or an examination as part of the underwriting process. It will be required when coverage exceeds a certain limit. The life insured has attained a specified age. Medical history reveals a medical condition. Example. In completing the non-med questionnaire on an application for long-term care insurance, Jorge disclosed the fact that he had a minor heart attack 4 years ago. In order to determine the extent of the damage to his heart muscle, the insurance company asked for an attending physician's report and a doctor's medical with a stress test. Confirmation of income. When the purpose of the insurance is income replacement, for instance, through a disability income insurance policy, income amounts and sources must be verified by income questions on the questionnaire, copies of personal income tax returns and the Canada Revenue Agency Notice of Assessment, T4s issued by an employer and T5s issued for investment income. Businesses must provide financial statements for, at least, the preceding 3 years. Replacing existing coverage. If a new A&S policy is proposed to replace an existing A&S policy, the agent must ensure the replacement is in the best interests of the client. The agent will be required to do a thorough comparison of many policy features and benefits. These include the premium, coverage, exclusions, riders, expiry date, waiting periods, and benefit period. For critical illness insurance, the definitions for what is conventionally referred to as the Big Four covered conditions, that is, heart attack, cancer, stroke and coronary artery bypass surgery, and any other medical conditions insured by the policy, should be reviewed in depth. 7.3 Underwriting by insurer. Underwriting assesses the applicants. Financial underwriting is shown by income. Medical underwriting is shown by health. Factors affecting premiums. Insurance companies consider several different factors when pricing disability and other A&S products. Note that the extent to which the insurance companies can control the prices varies. The considerations outlined impact premiums set by insurers. Administrative costs and expenses. Ongoing costs of staffing, marketing and issuing contracts and maintaining records. Increased costs and expenses lead to higher premiums. Investment returns. Returns generated by investing capital reserves. Increased returns lead to lower premiums. Lapse rates. Number of active policies that are canceled or terminated due to non-payment, lapse. Higher lapse rates lead to potentially fewer claims and lower premiums. Morbidity rates. Rates of illness or injury within the population. Increased risk of illness or injury lead to higher premiums. Ratings and exclusions. Ratings are a higher premium set for non-standard risks. Exclusions limit or eliminate benefits for specific conditions or causes. Both ratings and exclusions lead to lower premiums for standard risks. Morbidity rates. Morbidity is the instance of disability, injury or illness, in the population at large. The morbidity rate is the likelihood that a person, according to age, gender, occupation or some other factor, will suffer from a disease, illness, injury, or sickness. The mortality rate, in contrast to the morbidity rate, is the rate of death. Morbidity tables group large numbers of people according to their age or other factors to show the rate of disease, illness, injury or sickness for that group. Some insurers are more successful estimating morbidity rates than others, and consequently, their premiums reflect their accuracy. This may mean their premiums are higher or lower than competitors. Ratings and exclusions. As noted previously, ratings and exclusions are a way for the insurance company to manage the risk of a claim. Financial underwriting. Coverage that insurers will issue is restricted to a percentage of pre-disability income from all sources and is coordinated with benefits available from all other sources. The applicant must be a good candidate for premium payments after issuing into the future. This requires verification of the applicant's income and expenses. The life insurance company can lose money on a policy that is issued and lapses within several years. Medical underwriting. When medically underwriting a client and assessing the risk of whether to insure a given applicant, insurance companies evaluate the health of an applicant through performing a medical examination by a doctor or a paramedical professional, and often, but not automatically, asking for supplementary reports from the applicant's personal physician as well as input from the Medical Insurance Bureau, MIB. Attending Physician's Statement, APS. An attending physician's statement is a report from the applicant's doctor, outlining details of a condition or treatment incurred in the past. The personal physician of the life insured provides the attending physician's statement. It is requested by the underwriter, and the insurance company pays for the statement. The need for an APS is determined by the applicant's age, the policy coverage, medical history of the applicant or their family. Additionally, the insurer may request additional information or tests, such as a medical exam by a paramedic or physician, blood or urine tests, or an electrocardiogram. Medical Information Bureau, MIB. The Medical Insurance Bureau is an organization serving the life and health insurance industry by compiling historical data on lives insured and those applying for insurance. The insurer reports coded information to the MIB when an individual applies for insurance and also seeks such coded information currently on file with the MIB. An applicant must give permission for their information to be shared with the MIB. The information shared with the MIB provides general markers that indicate a possible health problem and could trigger the insurer to seek additional input from medical professionals. The MIB may also collect information about coverage currently in force, or currently being applied for, and instances where coverage was declined on an applicant. With this information, insurance companies can protect themselves against applicants seeking to overinsure themselves, to obtain coverage to which they are not entitled, due to medical conditions not disclosed to the insurer. This prevents applicants who have been turned down or rated by one insurance company from applying to a second insurer without disclosing either the decline or rating and the reason for it. MIB data can lead to an underwriter requesting substantiating information from a doctor or other sources. The data itself cannot be the reason to deny a claim or apply a higher, rated, premium. 7.4. Insurance contract. The issue of the contract by the insurance company to the applicant is the second step in the process of preparing a contract. The policy is an offer that requires acceptance by the applicant. The contract is completed when the policy is accepted and the policy premium is paid. The contract is the basis for all transactions between the policyholder and the insurance company. Need for prompt delivery. It may take many weeks for the policy to be underwritten and issued by the insurance company. Once issued, the agent is expected to promptly deliver the contract in person to the applicant. From the day of delivery, the policyholder has 10 days in which to review the policy and decide whether to keep it. If it is returned, or rescinded, by the policyholder, they will receive a full refund of their premium paid. Need for agent awareness of change since application. The Provincial Insurance Acts have specific requirements that must be met before a contract of life or A&S insurance is legally in force, such as the following. The insurance contract is delivered to the policyholder. The initial premium payment is made, and that no changes to the financial situation of the insured and the health of the life insured between application and delivery. The agent must ask the insured if there has been a change before handing over the policy. If the answer is yes, the policy must not be delivered. The change should be noted on the contract, and the contract must then be returned to the insurance company. Example. Agent Todd was delivering a newly issued critical illness policy to Lucille. In response to questions asked by Todd in the delivery interview, Lucille acknowledged that she had experienced chest pains, diagnosed as angina, starting about 2 weeks after she had submitted her application for insurance. Rather than deliver the contract to Lucille, Todd took particulars of Lucille's change in health, dates, the diagnosis, name of the doctor involved, etc., and forwarded a copy of his notes, with his report and the contract, to the insurance company for a reassessment. Dealing with rated cases. A rated policy, that is, increased premiums, exclusions, reduced benefits, etc., will likely not meet the applicant's expectations. This disappointment can lead to the policy being rescinded. To avoid rescission, the agent should mention the possibility of a rating if medical or other issues arise during the application process. Point out when the rating is temporary and can be eliminated when circumstances improve. Point out gently that the rationale for applying for the coverage has not changed and indirectly imply that the need for coverage is now greater since additional risk factors have been found. Providing contract disclosure. The agent is the insurance expert. The client requires the agent's expertise to fully understand the policy with regard to its benefits. Riders. Key definitions of covered coverage, particularly in regard to CI insurance. Exclusions. Particular attention should be paid to exclusions and definitions to minimize conflict between the insured and the insurer at the time of the claim. Factors that limit coverage, statutory provisions. Regardless of how many policies an insured may own, coverage will be limited to the following. Benefits from one contract cannot duplicate those from another. Disability coverage from all sources to a prescribed maximum of pre-disability income from all sources. Provisions outlining the priority of payer. CI policies have no specific limits on the amount of benefit. Long-term care insurance to actual expenses, up to the maximum. Example. Jorge has disability insurance coverage through his group plan at work that will pay him benefits of up to $2,500 a month, 50% of salary, for up to 2 years after a 30-day waiting period. If he wants more comprehensive coverage than that, he could, for example, take out an individual policy that would top up his coverage by another $500 a month, totaling 60% of salary, for 2 years and then increase to $3,000 a month for an additional 3 years. This would give him $3,000 a month of coverage for the full 5 years through the two plans combined. He could not, however, collect more than $3,000 a month from the two policies combined. Tax treatment of premiums and benefits. The agent should not provide tax-specific information that is beyond his or her area of expertise. A client seeking tax advice should be referred to a tax specialist such as a tax lawyer. Policy feature opportunities. Opportunities for sales may arise when the insurer takes advantage of the following contractual features. The future purchase option, FPO, rider. The insured may need coverage greater than the FPO provides. This can be addressed by taking out a new policy. Guaranteed insurability. Used by an insured with a critical illness policy to increase coverage. May be an indicator for more coverage. Conversion options. Used when a group plan member converts the group coverage to an individual policy. Must occur within the 30 days following departure from the group plan. Elimination of ratings or exclusions. The removal of a rating or exclusion is an opportunity to review overall coverage. Example. 2 years ago Consuelo purchased $2,500 a month of disability insurance coverage. The coverage was based on her income of $90,000 a year. At the time, she could have qualified for up to $4,500 a month of benefits, but some extraordinary personal expenses limited the funds that she had available for insurance. The policy she purchased has a future purchase option for up to $500 a month of additional coverage, without medical underwriting, provided she qualifies financially for the additional coverage. The first option to increase coverage comes up later this month. Consuelo met with her agent and confirmed that she would like the extra coverage. In fact, her cash flow would permit her to afford $4,000 a month of insurance benefit now. Consequently, she agreed to exercise the $500 option and to apply for an additional $1,000 of coverage with full underwriting. 7.5. Policy claims. The claims process is a very important part of the application process to the policyholder. The claims timing and content by the insured will be crucial to its success and credibility. It is very important for clients to ensure that all the information they write down on the claim form is complete, accurate and entirely truthful. Note that careless or false statements could lead to the insurer carrying out a lengthy adjudication process. During the claims process and when assisting the client, for example, when helping the client fill out his claims form, it is important for the agent not to put himself in the position of a conflict of interest, as a representative of both the insurer and the insured. The agent should be careful to follow the carrier's procedures if he assists the clients in the claims process, particularly when helping the client with the completion of his claims form. This is a delicate legal matter. Requirements for a claim. How is a claim made? The insurance company is notified of the injury, illness, or diagnosis as soon as possible following the event. The claims form is delivered to the disabled client by the agent or by mail. The claims form is completed by the disabled client. It is sent to the insurance company with original receipts or other supporting information. The insurance company seeks additional information, such as an attending physician's statement, about the medical condition causing the claim. The insurance company pays the claim in full or part or denies the claim. Standard contract limitations will apply and cause the claim to be denied, for instance if the injury is self-inflicted. Material misrepresentation on the application will result in the claim being denied. The income of the insured could reduce the claim if they earn less at the time of disability than when the application was made. Receipts. If benefits being applied for require reimbursement for medical or other services already rendered, such as dental work, chiropractic care, prescription drugs, etc., the insurance company will want original copies of receipts for the expenditures, in order to verify both the amount and appropriateness of the claim. These receipts should be forwarded by the claimant to the insurance company along with the appropriate claims form. Medical proof of diagnosis or treatment. All types of accident and sickness contracts require the occurrence of some medical event prior to the payment of benefits. For instance, disability policies require an inability to work and earn an income due to injury or illness. Critical illness policies require that the life insured suffer a covered condition or medical event, heart attack, stroke, etc., triggering a claim. Long-term care policies pay benefits based on covered expenses for an insured unable to fulfill at least two of the activities of daily living, IDLs. Business overhead expense contracts require an inability to work and contribute to the business productivity on the part of the life insured, due to injury or illness, and extended health policies may require an assessment of medical treatment, such as extensive restorative or cosmetic dental procedures, before expenditures are authorized for reimbursement. The insurer will not, of course, simply take the insured's word for the fact that he is suffering a disability, etc. It is going to want supporting medical evidence for the diagnosis. This will, at a minimum, require a report from the attending physician regarding the nature, degree and prognosis of the event that triggered the claim. In some cases, the insurer may also request additional tests or physical examination by a physician of their choice, to verify the condition. In addition, particularly in the case of disability, the insurance company may also want ongoing proof of treatment to rectify the situation. This again would require reports from the physician or other practitioner, chiropractor, physiotherapist, etc., treating the claimant. Review factors that reduce benefits. It may be that, at the time of the claim, the client receives benefits less than the maximum provided for under the contract, or no benefits at all. It is important that the agent assists the client to understand any such discrepancies. Possible reasons for a modification of benefits payable would include situations related to standard contract limitations seen in previous chapters, such as suicide, alcohol or drug abuse, criminal activity, etc. Similarly, all contracts provide that benefits are not payable if it is determined that the applicant made a material misrepresentation at the time of application. Furthermore, in cases where financial underwriting is required to determine the amount of benefits payable, reduced benefits may result from a change in the insured's financial situation. For example, disability benefits could be reduced if the insured's income at time of claim is less than was reported at the time of application. 7.6. Client service. Due to the ample competition in the marketplace, there are many companies and agents that can provide the product solution that the client needs. Good service is what makes the difference. The client communicates primarily with the agent, placing the agent at the forefront of the service relationship. Offering efficient and prompt service to the client is an important part of a long-standing successful relationship between the client, the agent and the insurance company. Agent's service role. An insurance agent's first role is to recommend solutions to meet clients' needs. An agent also has a role in servicing a client once a policy is in force. The agent's service role includes providing claim forms and other relevant documents, being prompt and accurate, developing a strategy for ongoing awareness of client situation and needs, determining suitability of recommendation and or the need for change, documenting services provided, staying in touch with the client on an annual or semi-annual basis, providing claim forms and other relevant documents. The agent provides service when changes are required to the policy, such as a change of address or beneficiary, electing an option, such as a future purchase option, or filing a claim. The agent may provide claim forms and other documents, and except perhaps for the claim form, they may assist the client to complete the forms and forward them to the insurer. A note with respect to services provided should go into the documentation file. Importance of promptness and accuracy. Promptness at the time of application is essential to ensure the applicant does not experience injury or illness that would prevent the application from being made. As noted previously, Accuracy and thoroughness are essential at the time of application and policy delivery. All policy changes must be handled promptly. Strategy for ongoing awareness of client situation and needs. Agents should seek annual reviews with policyholders to keep on top of possible changes and opportunities. Policyholders must be encouraged to share information that can impact the policy with the agent. All such information should be copied and placed in the documentation file. Example. Agent Sink stresses with his disability insurance clients that they must contact him immediately if there is a significant change in their employment status, change of income level, up or down, change of employer, change of duties, or should they become unemployed. Documenting services provided. As previously noted, documentation is critical for all actions taken by the agent in respect of each client. The documentation file provides an essential record that can protect the interests of the agent and the insurance company. Chapter 8, Group Plan Specifics. 8.1. Understanding the group. Group plan members actively working are automatically given coverage under the employee group plan. Group plan pricing is determined by general actuarial statistics, and previous claims, when available. Therefore, the insurance company must consider the group's makeup, the business's nature, comparative businesses. The employee data sheet contains some of the required information on members as well as the group itself, discussed later in this section. Makeup of the group. Groups are underwritten based on the character and makeup of the group. The multiple identities of the group establish the coverage and premium of group members since they are not typically underwritten medically or financially, as is done with individual policies. Thus, while dealing with groups, the insurer will deal with factors such as size, number of members, average age, gender and turnover rate. Number of members. The number of members in the group influences the insurance company's ability to estimate future claims and, therefore, to efficiently price premiums. Risk is more easily assimilated into large groups opposed to small groups. In a large group, say with thousands of members, the law of large numbers is likely to work and the claims of the group are likely to be as per actuarial norms or historical experience because the risk is spread over a much wider range. Therefore, the premiums for large groups can be more accurately determined. For small groups, with 25 lives or fewer members, for example, the claims of the group cannot be expected to keep in line with actuarial norms. Thus, smaller groups are often pooled with experience of similar small groups for pricing. Therefore, smaller groups are likely to have a higher premium than larger groups. Age and gender. Age and gender are risk factors for different types of claims and are important in determining the premium for the group, particularly disability and long-term care. Groups with more female members face higher premiums because the claims from a primarily female group are higher for health and disability claims than a primarily male group. Groups with older members face higher premiums than groups with younger members because older members are likely to file more claims for drug and long-term care claims. Turnover rate. The turnover rate is the rate at which existing members leave the group and new members join. The past turnover rate is a good predictor of the future group makeup, the percentage of group members likely to leave the group and be replaced by others annually. A low turnover rate is considered 5% to 10% of the group annually. A group with a high turnover rate will be penalized with higher premiums and longer waiting periods. Nature of the business. The type of business is critical to the premium cost and benefits provided by the group plan. For example, a construction business requiring hands-on activity exposes its employees to a greater physical risk than an office business where employees primarily work at their desks. Note that individuals who work in white-collar jobs may experience longer working hours as well as more work-related stress than others. These occupations may lead to the risk of more claims. Low-risk occupations are rewarded with lower premiums and more attractive benefits. Comparative businesses. When a group is applying for insurance for the first time, The claims experience statistics available may be unreliable or non-existent for the group characteristics. The insurer will then look into their statistics of groups in the same or comparative business to estimate the future claims and establish benefits and premiums. Employee data sheet. The employer is required to complete an employee census report that compiles information provided by the individual group members about their age, used to determine eligibility for certain benefits. Gender could be a significant factor in pricing. Occupational class. The plan may have different benefits packages for different classifications of employees, that is, factory workers versus executives. Dependents, required if the group plan has a standard or optional coverage including the spouse or children of the plan member. Social insurance number, required when benefits or premiums are taxable benefit to the group member. Salary or earnings, used to determine membership classes of benefits and disability income benefits. 8.2 Products and services. Group insurance products include disability income replacement, short-term disability, STD, and long-term disability, LTD. Extended health insurance, prescription drugs, vision care, dental, accidental death and dismemberment, AD&D. Critical illness, some group plans only. Long-term care, less common than other coverages. Employee assistance plans, EAPs, some group plans only. Elements of an employee assistance plan, EAP. Many employers provide an employee assistance plan, EAP, to employees as part of the group plan to offer counseling services outside more traditional benefits like disability and extended health services. An EAP is not insurance coverage but instead is a counseling service providing psychological counseling for psychological problems, addiction counseling for drug or alcohol addiction, marriage counseling for marital stress, legal counseling for personal legal services including divorce, the preparation of a will, etc. An EAP is an attractive employee benefit. The addition of an EAP to a group plan is an acknowledgement that employees may have personal or work-related stress that could impact negatively their ability to do their jobs efficiently. Some employers provide on-site EAP counseling services, but most employers provide services off-site through third-party providers to reduce cost as well as to reinforce the fact that the employee's use of the program is kept confidential. The benefits are in the form of consultation with a professional counselor. The services are typically subject to annual deductibles, a coinsurance and perhaps a maximum number of hours of services per year. Example: Sasha works for a large medical supply company that is in fierce competition with another major supplier. Market forces are putting a lot of financial pressure on her company and the senior executives are in turn putting a lot of pressure on their employees. As a consequence, Sasha is suffering from stress-induced stomach complaints, headaches and minor depression. Fortunately, her company has an excellent group benefits plan with an EAP. Through this program, Sasha is entitled to up to 10 hours of counseling with a psychologist, to help her develop coping strategies to deal with the pressure and avoid having to submit a stress-related disability claim. Though the statistics are uncertain, the EAP is implemented by the employer with the understanding that the EAP costs are outweighed by both the reduction in sick days as well as by the employee's increased productivity. Premiums are based on an experience rating. Experience rating is based on past claims experience for the group. Premiums are tax deductible for the employer. Benefits are not a taxable benefit to employees unless the benefits are provided for services related to physical or mental health of the employee or a person related to the employee, retirement or other financial counseling, employment placement for a terminated employee. Benefits for counseling for legal or financial matters are generally treated as a taxable benefit. Group insurers services. The insurance company supports its plan sponsors by enrolling new members, billing contributions, and claims adjudication, that is, assessment of the claim. Plan member enrollment. Employees complete an enrollment form to join a group. This occurs when employees join the employer sponsor or when they have satisfied the qualification period, usually 3 months after starting work. This is often handled by the Human Resources Department in larger organizations. Non-contributory plans. Enrollment is mandatory due to the predetermined benefits already in place. All benefits and costs are equal. The sign-up process is simple and typically only includes a completion of enrollment cards provided by the insurer. Contributory plans. Most group plans are contributory. 100% participation is not required. Some predetermined percentage of the employees must sign up before the plan can be put into place. No need to actively solicit members to participate in the plan. Employers often provide a 30 to 60-day window for employees to sign up. The insurance company assists employees with information and assistance as needed in order to ensure that the client fully understands plan benefits and options, particularly in terms of deciding on additional coverage. Underwriting is often required when a plan member seeks out additional coverage. Premium billing. The insurance company sets the premium for each group and bills the sponsor for the premium on a monthly basis. Non-contributory plans. Employer or employee plans. The insurer bills the employer one amount monthly that the employer is then required to remit to the insurer. Contributory plans. The insurer bills the employer one amount monthly that the employer is then required to remit to the insurer. The insurer informs the employer of each plan member's contributory portion of the premium. That contribution is deducted directly from the payroll for each member, and the employer is required to remit the total premium to the insurer. Claims adjudication. The adjudication of group claims is the company's primary administrative function. This involves a series of steps when a claim is submitted. 1. The claims form is compared to the contract to ensure the claim is contractually covered. The claim is denied if it is not covered in the contract. 2. If the claim is covered by the contract, an assessment is made of the benefit, whether it qualifies to be payable as well as how much is to be paid, and to whom. The claimant may be required to provide the insurer with additional information. 3. If the claim is approved, the insurer must make the correct payments to the insured. If the claim does not qualify for the plan benefit, it is denied. 4. The benefit is then paid. The insurance company will observe the maximum benefit and benefit period of the contract to ensure they are not exceeded. The company will also monitor on an ongoing basis whether the claimant qualifies for the benefit. For example, whether the claimant satisfies the definition of disability under the terms of the contract. Group brokerage services. A group broker is used to match the needs of a group plan sponsor with insurance companies that offer group plans. The group broker's value comes from his familiarity with the marketplace. The broker gathers the required data regarding the group's makeup and past claims. The broker then discusses with the sponsor which benefits are negotiable and non-negotiable. On his client's behalf, the group sponsor, the group broker collects quotes from different insurance companies, the group sponsor. He determines which company or companies are most in line with his client's needs and then makes a recommendation with the selected firm on behalf of the group. It is then the group broker's responsibility to act as the contact between the client and the account executive regarding the insurance company in question. 8.3. Coverage. A group sponsor may seek a replacement for the firm providing its group insurance plan if it believes the client pays too much, needs additional or more flexible benefits to be available, has had too many claims denied and/or poor service in the past, that is, there is a dissatisfaction with service including claim turnaround times. A group agent or broker will consider the following in shopping the market for a new plan: an in-depth analysis of the benefits offered, plan design, an evaluation of the group's claims experience, the overall level of satisfaction with the current group provider, existing coverage. A group agent should have a clear understanding of the existing plan's coverage including any insufficiencies that it may have. Evaluation of the existing group coverage relies on three separate elements: an in-depth analysis of the benefits offered, plan design, an evaluation of the group's claims experience, overall satisfaction level with the current group provider, existing plan design. The existing plan coverage is examined to review past coverage as well as an analysis of needs should the plan sponsor wish to consider the offering of other insurers. The agent should ask, what does the existing plan provide? Why is there dissatisfaction with the plan? The answers to these questions can steer the group agent towards a provider that better meets needs. An in-depth analysis of the existing plan should include the type of coverage, the scope of coverage, covered conditions, products and services, benefit limits, definitions, deductibles and coinsurance factors, etc., and the type of funding in place. Claims experience. Past claims are a major contributor in order to determine premium pricing and plan design. Premium pricing reflects the amount of claims a group makes. Therefore, a group that makes a lot of claims will typically have to pay higher premiums when the plan is renewed or when seeking out a new insurer. The plan design may be at fault for a high rate of claims if the plan offers generous benefits and maximums, and does not offset costs through the using of waiting periods, deductibles and coinsurance. Many factors need to be considered and the following questions need to be answered. Is the coverage very broad? Are the definitions of a covered event, product or service very liberal? Are benefit maximums very high? Are there deductibles, coinsurance factors and waiting periods designed to minimize claims? Satisfaction with current provider. Concerns about the current provider must be considered before approaching a replacement or a new carrier. Proposed new coverage. Price should not be the only determining factor for switching to a new group carrier. Therefore, it is important to conduct an in-depth examination of the plan design in order to determine whether value or price is the main element of the proposed plan. New plan design. A true comparison must be made of each element of the existing plan against the proposal of a new provider. Simply comparing premiums is not enough. A comparison between disability plans asks: what is the definition of disability of each plan? What is the waiting period? What is the short-term disability benefit period and how much income is replaced? How about the long-term disability benefit period and income replacement? Is rehabilitation offered? Drug benefits can be an ongoing drain on a plan, especially when dependents are covered. An analysis of the existing and new plan asks: what is the deductible of each? Coinsurance? What drugs are covered? Brand name or generic coverage? Pay direct or reimbursement? The same exercise should be carried out for each product, for example, extended health, vision, dental benefits, long-term care, critical illness and EAP, that will comprise a part of the future plan. Funding formulas. The group sponsor has three choices of how to pay for the group plan. Non-refund accounting. Refund accounting. Administrative services only. Non-refund accounting. Non-refund accounting refers to the more traditional form of funding a group insurance plan through the use of a fully insured, pooled, plan. The insurance company assumes the complete responsibility for paying all claims. Premiums are set by insurance companies based upon the predicted periodic cost of claims. These predictions are based on past claims experience. As its name suggests, there is no refund of premiums to the sponsor when claims are less than premiums paid. Claims greater than premiums are the responsibility of the insurer. However, if claims exceed premiums, the sponsor may fund premiums increase at the time of renewal. Refund accounting. Refund accounting is also known as the retention accounting method of funding. Premiums are based on the group's past claims experience and are set based on future anticipation of claims. A partial refund of premiums is received by the sponsor when claims are less than premiums paid. The insurance company has the opportunity to recoup its losses at the time of contract renewal when claims are more than anticipated and premiums paid. Administrative services only. a SO. The group sponsor pays all claims when it has an administrative services only, a SO, contract. The administration of the plan is handled by the insurance company. There is no insurance element to the plan as the plan sponsor is assuming all risk of paying the claims. The plan sponsor outsources the administration, record keeping, pricing, adjudicating and paying claims, etc., to an insurance company. A SO is suitable for organizations with a very large number of employees, substantial assets and cash flow. Responsibility for premium payment. Employer-employee plans can be structured either as a contributory plan, with premiums shared between the employer and the employee, or as an employer-pay-all non-contributory plan. Group association plans are typically fully contributory, the premium is fully paid by the member. Non-contributory. The plan sponsor pays the premiums. It is usually a requirement that 100% of qualifying employees join the plan and there is little or no opportunity for the group members to vary their benefits from a set schedule. Contributory. The plan sponsor and the plan member share the premium cost. Membership in the plan is optional, although a minimum number of employee members will be required to participate in the plan and there is little or no opportunity for group members to vary their benefits from a set schedule of benefits. Contributory plans offer more flexibility in selecting benefits, although some base coverages may be mandatory. In a fully contributory plan, plan members pay 100% of premiums. This is the form of payment for group association plans, such as a plan offered by a professional group to its members. 8.4. Costs. Several factors determine the overall costs of group insurance. Premium rates. Taxation and group plan registration. Claims experience and other product cost drivers. These elements are briefly discussed in the following sections. Premium rates. Several factors affect group premium rates, such as makeup of the group. The number of members in a group influences the insurer's ability to estimate future claims. The group members' average age, gender and turnover rate greatly influence premium pricing. Nature of the business. The level of benefits offered and premium pricing under the group plan depends on the nature of the business, specifically the type and level of risk that employees are exposed to. Group benefits offered. Premium pricing is directly linked to nature and the level of benefits offered, increased coverage yielding typically higher premiums. Past claims experience. The carrier will want to predict future claim rates on past claims experience in order to determine the right premium. Manual rating. If a group is acquiring insurance for the first time, its premiums will be based on the claims experience for similar groups. This method is also called pooled pricing, experience rating. When a group is renewing its plan, premiums will be based on the claims experience of the group. Here the assumption is that the group is sufficiently large for past claims experience to be statistically meaningful. Blended rating. The premium is set through typically blending rates from both the manual rating and experience rating. The degree to which the past claims experience influences the pricing is dependent on how credible the past experience is considered to be. Credibility. Credibility refers to a way of establishing how reliable experience rating is in a particular case. Credibility is the result of a low turnover and a history of group plan ownership by the sponsor. Together, they provide the best indicator of future claims and become a credibility factor in determining the premium. A large group with a number of years of claims experience may have a high credibility. A small group with high turnover rates will have a much lower credibility. Groups with no previous coverage will have a nil experience credibility rating and, as a result, premium rates would be based exclusively on a manual rating approach. Example. The Master Mobile Company has a workforce of 37 employees and an annual employee turnover rate of 18%. The company has had a group benefits plan in force for 4 years. Their claims experience credibility has been rated at 40%, meaning that insurance premiums will be based 40% on their previous claims experience and 60% on the standard manual rate for a group of their size in a comparable industry. Taxation and group plan registration. Group A and S plans have tax implications that must be considered while determining the overall cost of the coverage for the plan sponsor and plan members. The issues to be considered are: employee payment of long-term disability premium, registration of short-term disability plan with Employment and Social Development Canada, ESDC, group premium tax, employee payment of long-term disability premium. The tax ramifications of premiums and benefits are an important factor to consider when forming a long-term disability plan. Employer-paid premiums for Group A and S products are a tax-deductible expense for employers, in spite if they are a taxable benefit for the covered employees. The taxation of disability benefits hinges on who pays the premium. Employer pays 100% of premium equals taxable income for the employee. Employee pays 100% of premium equals tax-free income for the employee. Employer and employee share premium equals tax-free income for the employee equal to his premium contribution, balance is taxable income. Example: Shauna is a member of the group insurance plan where she works, which provides her with disability benefits of $1,200 a month. Shauna and her employer share the cost of disability premiums 50-50. Since the inception of the plan, each has paid $3,600 in group disability premiums and, until last year, Shauna never had a claim. She was sick last January and was off work for 10 months, receiving $9,600 in disability benefits, her first $3,600 of benefits, equal to the premiums that she had paid into the plan, were tax-free, while the other $6,000 of benefits was a taxable benefit to Shauna. In most contributory group plans, the employee's portion of the group premiums paid is structured to pay 100% of the group disability premiums first. Registration of short-term disability plan with Employment and Social Development Canada, ESDC. Employment and Social Development Canada, ESDC, is responsible for overseeing the Federal Employment Insurance, EI, program. EI participants receive a 15-week disability benefit, following a 14-day waiting period, upon sickness or disability. An employer may reduce its EI premiums if it provides short-term disability coverage equal to or greater than the EI benefit. This is because EI is the second payer and its benefit would not be paid when the group STD plan is paying a benefit. The STD plan must be registered with ESDC for the employer to receive the partial reduction in EI premiums otherwise payable. Group premium tax. Part of the premium includes the provincial premium tax, typically charged at 2% to 3% of the net premium. The tax applies whether employer or plan member pays the premiums. The tax is part of the overall premium quoted rather than being broken out as a separate charge. Example: Jorge pays $150.81 per month for his group long-term disability insurance coverage. The $150.81 monthly charge represents the base premium for the coverage of $147.06 plus a 2.55% premium tax of $3.75 calculated as $147.06 times 2.55%. Claims experience and other product cost drivers. Anticipated claims are the basis for premiums. As noted previously, plan design can contribute to lower premiums by including deductibles and coinsurance. Benefits that are perceived as free to the member, no deductible or coinsurance factor, are more likely to be claimed. Extending the waiting period for disability. This can eliminate costs associated with short-term claims. Eliminating brand name drugs, high-cost drugs, and non-prescription drugs from a drug benefit plan. Making a plan non-contributory, so that members do not feel a sense of entitlement to use something they paid for. 8.5. Claims administration. It is a group insurer's responsibility to administer claims made. What is the process for paying a claim? The claimant notifies the insurer of claims, and provides the insurer with claim forms and proof of claims, that is, a doctor's note. The insurer verifies the plan is in force, the member is enrolled in the plan, and the requested benefit is provided by the plan. The claim is adjudicated and, when approved, paid by the insurer. For large groups, communication with group sponsor and members would be the responsibility of the representative of the insurer. Small groups may need the agent to communicate with plan members. 8.6. Coordination of benefits. The coordination of benefits, COB, is a clause in the master contract. It specifies rules for members who are covered by more than one group plan, often through family coverage via spouse's plan, so that benefits are not duplicated. A member submits a claim first to his own plan. If it is not paid in full by his plan, it is then submitted to the second plan, usually the plan of a spouse. The second plan pays the lesser of what it would have paid if the claim had been filed first with that plan. The sum of the total expense minus any benefits already received. Claims for dependents in all plans, children, are submitted first to the plan whose parent has a birth date earliest in the year. For example, Dina and Adam's son, Josh, goes to the dentist and the bill for his services is $440. Dina's birthday is October 12th. Adam's birthday is May 2nd. Therefore, the claim for Josh's expenses is submitted first to Adam's plan. Example. Jasmine and Abdul are a married couple, both working in the computer industry, but each for a different company. Each of them is a member of a group plan that offers benefits to employees and their spouses. The plans are provided by two different insurance companies. Both plans offer dental benefits, including restorative services, like caps and bridges. Jasmine's plan has a $100 annual deductible on dental claims and a $1,500 annual maximum on restorative services. Abdul's plan has a $50 annual deductible on dental claims and a $2,000 annual maximum on restorative services. Last year Jasmine fell while hiking and damaged her front teeth. The dentist bill for the restorative work was $2,500. It was the first dental claim against either plan for the year. As the patient in question, Jasmine claimed first against her group plan carrier. She was responsible for the first $100 of expenses, under the plan's deductible. Of the other $2,400 of expenses, her plan reimbursed her $1,500, the maximum allowable in 1 year for restorative services. That left Jasmine with $1,000 of dental expenses that her group plan did not cover. The couple then submitted the entire $2,500 bill to Abdul's plan as well. If it had been the primary carrier, Abdul's plan would have covered $2,000 of the claim, after allowing for the $50 deductible. Since Abdul's plan, as second payer, is required to cover, under the coordination of benefits rules, the lesser of what it would have paid had it been the primary carrier, $2,000, and the amount of the claim not covered by Jasmine's plan, $1,000, the plan covered $1,000 of the expense. By combining the two plans, Jasmine was fully reimbursed for her dental expenses. 8.7. Agent's service role. In some cases, the agent associated with a group plan is not actively involved in group business. His main responsibility, in this case, is the identification of a group prospect and introducing that prospect to a group representative. The agent receives a commission when the group plan is successfully put in place. However, if the agent is actively involved in both selling and servicing the group plan, the agent has the following responsibilities: remaining up to date on the client's situation and needs, and documenting the services provided. The introduction of a new plan in a workplace requires the agent to educate members about the plan and its benefits. Ongoing awareness of client situation and needs. The agent should plan regular meetings with the client to keep on top of issues as they arise and change. It is important for the agent to prepare a plan for recurring client-agent contact. This plan will help the agent to Strengthen client-agent relationships. Assist the client with any concerns regarding the insurance company. Encourage client referrals. Request quotes from other providers and make recommendations if the client wishes to shop the plan. Contact should be made 90 days before the annual renewal date to check for changes needed in the renewal contract or to seek another provider. Documentation of service provided. As noted previously, documentation of the interaction with the client at all steps of the service process is very important for the protection of the client, agent, and insurance company. The agent's file should include copies of all written communication, including emails, quotes, and letters. It is important for the agent to record dates of contact with the client, what the agent discussed with the client, what action was taken, how the matter was solved. Note that it is essential for the agent to make special note of any contentious issues between the client, insurance company, and agent. This documentation is kept in order to guarantee that the client was properly served throughout the entire service process, and to keep a record in case a complaint is made in the future about the agent or the insurance company.